Today, you're going to hear from the following: Mester, Williams, Goolsbee, Logan, Bostic, and a whole lot more. Chairman Powell on Friday. Andrew Hollenhorst's City weighing in on the mess and what we might expect and what we might hear from the chairman, writing the following: he is unlikely to signal a bias for actions at a mid-June FOMC meeting, instead emphasising that policymakers will be data dependent. The crucial information will be whether Powell echoes his colleagues' concern that inflation is at risk of getting stuck above 2%. Tom, I have to say, some splintering in the Fed speak in the last 24 hours.
Maybe led by the former Vice Chair Richard Clarida. We've been wonderful to have him grace our show on the Fed Day, and it's a percolating debate about the above 2% idea. Let's go to Andrew Hollenhorst right now. He's Chief U.S. Economist at Citigroup, acclaimed for really being out front on a set of rate increases many people did not see coming. Andrew, I want to go to the unspeakable, which is the 3-month Treasury bill has gone back up to 07, 08 levels. What is the ability of the 3-month Treasury, given what you see at Citigroup, to go up to where it was in 1999-2000, to get up to a 6% level?
Yeah, so it is interesting, Tom, that we've seen these rates that have gone up quite rapidly as the Fed has responded to inflation. And I think that's where I would just take the conversation back to. It really still all depends on inflation. What John was just talking about, and we have some different views across the committee. I think that's a healthy thing. There's some discussion now. Is inflation going to get stuck above 2%? Is it going to come down towards 2%?
Right.
Markets are expecting a pretty rapid slowing in inflation. Fed officials are a little bit more cautious about that. But if you look at where they have their forecast at the end of this year, they have core PCE inflation around 3.5%. So they really do see it slowing. In that world, you're going to see those short rates that aren't going to go a lot higher than where they are now. In a world where inflation stays higher, you could start thinking about higher policy rates again.
People like you are taking all sorts of different inflation measurements. I noticed Goldman Sachs publishing this morning off their London desk a trimmed core CPI number. Should our viewers and listeners be looking at fancy economic inflation metrics, or should they, like the Fed, just be looking at core CPI and top CPI?
So I think you want to look at all of it. That's really the approach that we take. There are so many different measures of inflation you can look at, to your point, Tom. The Atlanta Fed has an underlying inflation dashboard. All of those metrics are running quite high. You want to be careful, though, because if we start getting into the game of, let's throw out this component, let's add this component, let's adjust this component, you can get any inflation number that you want. If we just look at the monthly core CPI readings, they've all been, for the last 5 months or so, right around a 4 or 5% reading. So, like John was talking about, you actually have some, kind of stability on average in certain indicators. And core CPI is one of those indicators where it's just kind of consistently coming in around 5% annualized. And that's a problem for the Fed.
Andrew, do you think this effort is time sensitive? Or does the Federal Reserve have the luxury of pushing out the appropriate time horizon to get inflation back to target?
So it's not going to make a big difference to the economy if the Fed hikes in June or waits in June, maybe hikes later on. So on the economic fundamentals, that timing is not crucial. But on the communication, the timing can be extremely important, because if the Fed doesn't hike in June, if the Fed guides that they're going to be on hold, then the market is going to price back in cuts, and that's kind of what the Fed has been dealing with. And if the market prices in cuts, then you get a lower 10-year yield, you get more stimulus for the economy. By the way, the housing market has bottomed. It's coming back now off of that bottom. So that kind of communication is what the Fed is managing more than anything else when they're deciding what to do on a meeting-by-meeting basis. Economically, they are in a situation now where, I would agree with St. Louis Fed President Bullard saying that policy rates are now at the lower end of a reasonable range of what could be restrictive. So they want to be looking at data. That's what they're doing. Depending on where that data comes in, is going to determine their next step.
With that in mind, Andrew, given that we are seeing very subtle signs, and I put the emphasis on subtle, that we're seeing some splintering on the committee, just a different range of views, subtle shifts over the last 24 hours. Does the chairman not have a role to play this week to get a hold of the narrative and really push forward with what you're indicating?
So the chairman has a big role to play. I think the question is whether he is going to play that role this week, or that's something that we're going to wait a little bit later for. The issue with this week is we have a core CPI reading. We're waiting for a core PCE reading. We're waiting for a jobs report. We're waiting for another CPI inflation report that's going to come out right ahead of the June FOMC meeting. So when you're in this very data-dependent period, it's going to be hard for any Fed official to push too hard towards either being on hold or towards hiking. You really want to see the data. So I think that's more what we're going to hear from Chair Powell. Yes, at some point he needs to bring this committee together because we are hearing very different views on inflation. Some Fed officials calling it discouraging, some Fed officials calling it encouraging. Ultimately, Chair Powell is going to have to bring the committee together.
In a little bit, we're going to be speaking with Ed Yardeni, who thinks that if disinflation continues at the pace that we've currently seen, that CPI could reach 3 to 4% by Christmas. And this is their wonderful life forecast that stocks seem to be buying into. How do you push back against that? I understand that the housing market is rebounding, but some of that hasn't even gotten factored into that weakness into CPI as is. How do you push back at a time where there are signs of disinflation?
Yeah, so no doubt you have goods prices that have slowed. You have shelter prices that are slowing. Now, if I look at forward-looking indicators, it's not as clear that that slowing is going to continue. The important thing to keep in mind in analyzing inflation is that this is a dynamic process. So we had shelter prices that were running very strong. They're still running strong, but they're cooling. Goods prices were strong and they've cooled. This has shifted now into non-shelter services inflation. And that is probably the worst place for inflation to be showing up. That's where it has the potential to be most pernicious, most persistent, most long-lasting. So I would really be concerned if I were a Fed official about what's going on in services inflation. I wouldn't take it too seriously, but I would be a little bit concerned about University of Michigan 5 to 10-year inflation expectations that moved up to 3.2%. I think that's more kind of qualitative than quantitative, but that's the highest reading that we've seen in some time. That's telling you that these inflation expectations are becoming embedded in the economy.
Andrew, are the debt ceiling debates and the discussions that we keep hearing and the likely fiscal cuts that are probably going to follow, is that disinflationary?
If there were going to be cuts to spending, that would be disinflationary. But remember, as we're hearing about the negotiations around the debt ceiling, the caps on spending are probably not going to apply to overall spending. There'll be certain categories of discretionary spending that get capped. Things like defense spending can continue to grow. That can be inflationary. So I'm not sure that what we get out of this is ultimately going to be all that deflationary.
Andrew, looking for hikes in June, looking for hikes in July. Andrew Hollenhorst and a team over at Citi together with Veronica Clark. Great to catch up with you, Andrew. As always, buddy. Your equity market negative 0.1% on the S&P. I'll keep going through the calendar, the diary for you this morning, 8:30 Eastern Time. US retail sales a little bit later on today. We'll hear from Speaker McCarthy and President Biden in their debt ceiling negotiations, TK. Then on to tomorrow.
When is this afternoon?
Target, then Walmart coming up on Thursday.
When
3 p.m. Eastern Time, I believe.
Close?
3 p.m.
That's when their day starts.
I imagine by the time that's concluded that they come out and do those individual press conferences.
Yeah,
you know the ones, Bremo.
the driveway.
We love those. They get in a driveway, get in front of the mic.
Yeah, Anne-Marie's got a brass.
There was no progress.
That was good.
Yeah. Well, I mean, what Wendy Schiller said I thought was fascinating, that basically there is no incentive for Republican representatives to come out and say that there was a lot of progress because this is something that plays well for the constituents. So how do you read the Democrats coming out and saying, it was fantastic, we had such a good collaborative
No, they're not going to say that
Republicans
today. I mean, are we seriously? Are we right today? They're going to say they're making progress. The staff is talking, but they totally disagree, right? Because they're playing to their constituencies.
I have no idea because I don't have a crystal ball about what they may or may not say. I can tell you what they have said. That's our orb, isn't it? That's our orb.
Yes.
I can tell you what they have said. Kevin McCarthy coming into this has basically suggested there has been no progress. Does he stay on repeat a little bit later?
Well, and again, how much is the incentive? We see you. We see you, Tom.
What did you learn from that? Did we ever find out what that was about?
This is, folks, for those of you without unfortunate,
yeah, I do.
This was Saudi Arabia
and
President Trump
what was
looking
that
at
about? What was that? I still don't know. They all had the org.
It was the golden glow of OPEC and the
That's what it was?
experience of connecting, and I have no clue.
I think there was actually something serious to it that was lost on Western minds.
Oh, there was?
I think so. What's important about this, Brammo gets me going, and you guys don't know this, but I'm trying to help Mayor Adams here, and I got the mower out. I mean, I'm trying to help Home Depot as well. And John, for $82 large, you're into a push mower to help mow Central Park.
Is that how much a push mower costs?
It's like, it's made in Asia, and it's great, and you got to resharpen it.
Are they really like $82 now? Wow.
Yeah, well, the locks are $1 million. I used to have a lock, which is a fancy golf.
I used to work that petrol one when I was a kid.
Yeah.
Yeah.
Do the back lawn.
We call that Briggs and Stratton, American
Is that what it was? Briggs and Stratton?
It
I'm not
takes
sure- I'm
forever
not
to
sure
get it
what brand
started.
was. Yeah.
Yeah, and then like a puff of like gas comes out, and
That's
you
it.
smell
That's
it.
it. You know,
I
Great.
take it
Smell the
down. I
gasoline.
take it down to get it
smell the
sharpened.
gasoline. It's great.
John, I take it down to get it sharpened. Madison in the 70s somewhere. You know, they sharpen
And then you go
goes
out,
down
you
there.
go out into Central Park.
With a cigar.
I can't see that.
That right.
At all. The cigar piece of it, absolutely. Every afternoon in Central Park, you can find TK with a cigar. Equity futures on the S&P, negative 0.1%. Chuck Grom, Gordon Haskett on retail earnings coming up next.
And he'll also be with a beverage of his choice as well. You know that. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. The White House and congressional leaders head into another session of debt limit talks today to try and avoid a default. President Biden has said he was optimistic a deal could be reached, while House Speaker Kevin McCarthy expressed that ongoing discussions were not productive at all, and leaders are nowhere near reaching an agreement. The former CEO of Silicon Valley Bank says the Fed and social media contributed to the lender's collapse. Greg Becker testifies before the Senate Banking Committee today. He's expected to blame the fastest pace of hikes by the Fed in decades. According to his prepared remarks, Becker also will point a finger at negative social media sentiment. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
In today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. If I had to have a vote right now, I'd probably vote to hold. But as you noted, we got two more inflation readings. We have a jobs number, a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
Great conversation with Mike McKee and Raphael Bostic there, the Atlanta Fed Bank president. Tons more coming from the Fed this week, including Chairman Powell on Friday. Going into all of that, your equity market more broadly, just a little bit softer this morning. We're negative by 0.1%, a whole lot softer, more negative than that. Home Depot in the pre-market, down by almost 5%, out about 45 minutes or so ago, coming out and cutting the outlook, Tom, for 2023. Comparable sales could decline between 2 and 5% this year. They've blamed a whole bunch of things: unfavorable weather, lumber deflation contributing to the drop? I think other people might have a different view on things.
There's a wide set of ideas here, and I do suggest weather comes into it, but that's always been true. They're up 17% per year for the last 10 years, and I think weather debates have been there each and every quarter. Good, bad, and indifferent. I mean, I'm just not going to go to the weather.
Have you noticed it's only FX when it's bad?
Yeah.
You know, like, and it's only weather when it's bad. But when it's good, it's us.
I was going to say the exact same thing. It's like, how much is weather the new FX trade, this dollar strength, or the dollar fluctuations, or whatever it is that we've got? Yeah.
Let's talk to an expert. We're not, I mean, Lisa's an expert on this because she's at Home Depot 3 times a week. John and I are clueless on this. Somebody really competent is Charles Grom. Chuck Grom is senior retail analyst at Gordon Haskett and joins us right now. And what's so very cool about this out of the College of the Holy Cross is this is one of the coolest things on the securities research side. This gentleman is a CPA and a CFA, and that is bulletproof across Wall Street. Combine the two, combine the accounting, Chuck, and also the financial analysis of the CFA designation. Is Home Depot a different company than the company we've known for 20 years?
No, not at all. I mean, I think there's a lot going on with the consumer right now, and you touched on it in terms of the weather impact. But I think the key line out of the Home Depot release today was demand starting to normalize, and I think that's something we haven't heard from Home Depot in quite some time. And I think that's the big issue, and understanding how long that's going to last is really going to weigh on shares here in the near term. But let's face it, I mean, March was very unfavorable from a weather perspective, but April wasn't. And we don't know the exit rate for the month of April right now, but we suspect it was weak. And so you can't hide behind weather right now.
One of the distinctions they have is they own the pro market, or at least that's the verbiage. Do they still own the pro market? And is that the Home Depot distinction forward?
Oh, 100%. I mean, let's face it, nothing really structurally has changed here with Home Depot. The stock's down a little bit pre-market. They didn't have a great first quarter. They're cutting the guide for the year. But pro business, north of 50% of their sales, they still dominate that part of the market, particularly relative to peers. Lowe's is way behind at close to 25%. So again, that has not changed at all today.
How much is this really a housing-specific sector issue, a construction-related issue, just simply because there has been so much investment in people's homes, there has been purchases, and prices have gone up so much?
Yeah, I think it's all of that. I think demand normalization again is the key here. But you know, when rates are this high, people are not moving. But let's face it, people have jobs, so they're still investing in their homes. We're just seeing category demand normalization across the board. And I do think that their seasonal business, we'll learn more on the 9 o'clock call, was also soft because of some of the issues with weather here.
We are seeing Lowe's shares down in sympathy. As you can see, those shares down almost 4% as well. So people seeming to believe this is a sector-specific issue. Moving ahead to Target tomorrow and then Walmart on Thursday, how much are we going to see a similar trend in those retailers at a time when a lot of different stores are saying that they can pass along price increases and then some?
I think retailers are going to have a much harder time, you know, taking price from here. I think we're starting to see the consumer push back. We're seeing consumers start to trade down into companies like Walmart and into categories and private brands in particular. So we're cautious on Target. We're more optimistic on Walmart. I think that the key thing here is we're starting to go through a discretionary recession across retail. And I think we're actually already in it. And I think we're going to start to hear that from a lot of companies over the next couple of weeks. If you rewind the clock, you know, the past couple of weeks we've heard from Costco, their business has been softer. It's very atypical for Costco to have that volatility in their business. So if Costco's volatility is there, Home Depot's business is softening, it's happening everywhere.
One of my big themes, Chuck, is management's adapt. How does retail adapt to the slowdown you describe? Is it layoffs? Is it protect the margin and EBITDA at all costs? What's the prescription here looking at history?
Well, I mean, the number one thing they need to do is protect the balance sheet and control inventory levels. And if there's anything that could happen in 2022 was demand started to soften and inventories started to get in better shape. Are they there yet? Not really across the board, but they'll start to get there. And, you know, for Home Depot, their SG&A expense control was very, very good in the first quarter. That's why even with softer business, they were able to come in with earnings of $382. So the first thing will be inventory. Second thing will be cost control. And I think the third leg would be job cuts down the road if business continues to deteriorate.
Chuck, that phrase, discretionary recession, can we dig into that just a little bit more? Is that up and down income brackets? Does that go from goods to services? Can you give me a little bit more detail on what you're looking for there?
Well, I think it's a little bit more goods than services right now. I mean, you look at the travel industry, and anybody that's been at the airport or been on an airplane the past few months, they're always full. So people are definitely shifting spend towards services. But I think it's the categories that my companies sell into. We're just seeing softness across the board. You know, whether it's consumer electronics, whether it's home furnishings, whether it's home improvement in this case. You know, again, all three of those are starting to see weakness.
Chuck, how much is this going to really challenge the fact that companies have been raising prices beyond their input prices? In other words, that profit margin has to come in much more than people are expecting.
Yeah, I mean, that's a really good point. And I mean, and that's what we're going to have to watch, the elasticity across the board. You know, we're starting to see it in discretionary areas start to normalize on the price front. We'll start to see it in CPG areas, food areas in the coming months as inflation starts to pull back. I'll just point out that just traffic across retail has been very, very soft over the past 2 months, and that's always a harbinger of things to come, and it doesn't look good. The consumer's pulling back, and frankly, like none of this should be a surprise after the past couple of years of splurging across the consumer space.
Chuck, I'm looking at this weekend buying the American push mower for $82 from Home Depot. I mean, we got to mow Central Park. I got to do my part for Mayor Adams. Where's their perfume section? What part of Home Depot is where they really make the margin as they get to 16% EBITDA?
It's really pretty even across the board. It really in the seasonal areas, home furnishing area, that's where the margins tend to be the best. But if you go back to here, this print for Home Depot, again, like it's not pretty, but the gross margins are actually pretty well protected, and their inventory levels are in good shape. So it's not a great print from Home Depot this morning, but it's also not the end of the world, in my opinion.
Chuck, this was smart. Let's do this again soon. Chuck Grom there of Golden Haskett. Thank you, buddy. Appreciate it. That phrase, discretionary recession, just making notes as Chuck was talking. Consumer electronics, home improvements, Lisa, home furnishing. Are we going to see that later this week in Target and Walmart as well?
And he says yes, and he says that traffic has been really light and that's a leading indicator, and he thinks that in general consumers are pulling back. But to me, the fact that this is the leading signs at a time when the consumer is king, and that's what's been driving all the upside surprises in both inflation as well as growth, doesn't bode that well.
And John, you mentioned this yesterday. I think it just goes back to charge card usage. You really, we got productivity coming out today and a bunch of bow tie economic stuff, baloney. It's about charge cards and about what people are actually doing with credit in this time. Not only small business, but individuals as well.
We started to see some signs of that. I think that got drowned out by the regional banking issue.
Yes.
But from the major banks, Lisa, we started to see some signs of that. Just credit starting to build. Starting to see people carry over balances month to month. The kind of things you start to see where weakness starts to come through.
We got that survey yesterday from the New York Federal Reserve, and it showed that credit card receivables, the outstanding balances, have not gone down in the first quarter for the first time for the same kind of period in 20 years. Normally, people pay off the bills from Christmas time, from the holidays. They did not do that this year, and that really raises some flags to some people.
When do you have the time to look for that data? I mean, are you sitting at home waiting for the charge card data?
Yes, I am.
Some of us like to read some of that data.
Hold on with
the
homework, guys. The Fed's coming out with charge card data.
Actually, no joke, I actually do call the kids over. I'm like, check this out. Isn't this interesting? And their eyes start to glaze over, and they start to look at their phones. And I say, no, this is important.
It's nice that you share that with them. I think it's nice.
Basically, I might as well be talking to them all.
I'm watching the new Pitch Perfect 3 at home. That's a little different. It's just great.
This is some really important stuff, though, guys. I mean, look, Doug Cass this morning writing in almost immediately and saying this is classic pull forward in demand. Just like some of the tech names, we saw that with the likes of Home Depot, people doing things with their homes through the pandemic, all of that good stuff. We pushed out demand for travel and leisure when it came to airlines and flying and vacations and all of that stuff. So how long, Bramo, before we see this go from goods to services?
This is what people are expecting, the disinflation that Adiardini talks about.
Cass is down in Florida. He's got 2 parrots in his house. One's called LIFO, the other's called FIFO.
Is that right? Can you confirm that?
Yeah, I can confirm.
I'm sure that's true. I doubt it.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
In a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C. It's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, this is a national problem. And, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we're all part of an organization that's coming together that says if you've, we can put our camera feed together and tell that person has been in our store and their store, and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades?
I will tell you, it started at razor blades because that's such a high ticket item, but, it's a lot of cosmetics. But really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
I'm leaning towards the bond market view that we're in for some volatility.
We're kind of bouncing into a ceiling at a floor, effectively.
We think the market's a little bit generous in terms of Fed cuts coming.
The Fed has done a very good job of continuing to support the economy while raising rates and trying to tame inflation.
I'm in the camp that it's not going to go neatly back to 2%. I think there's another upside surprise waiting out there in the inflation data.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market just about negative on the S&P 500. Big week for the U.S. consumer. Later on this morning, 8:30 Eastern Time, retail sales in America. Target numbers tomorrow. Walmart earnings the day after that. This morning, Home Depot, that stock is negative by 4% in the pre-market after cutting its outlook for 2023. TK blaming lumber deflation, disinflation, take your pick, and also the weather. But I think other people going this morning a little bit further than that.
Well, Chuck Graham was great there, and I think Lisa really underscored it, the idea of units through the door. It is about bodies, and whatever it is in retail, you got to get them through the door, whether it's physical or online, and that seems to be the problem, and that leads to a diminished comp sales statistic or set of statistics, I should say. And what we've got to remember is this is a dominant, well-executed machine, sort of the Apple computer of retail, if you will. And if Home Depot's struggling like this, what are the others doing?
Maintaining margins. Chuck Graham talked about that at Gordon Haskett. But then he came out with this phrase, and I think this phrase got the attention of all of us. Discretionary recession. He went through things line by line. Consumer electronics, home improvements, home furnishing. Doug Cass, as he said 10 minutes ago, Lisa, we had this big pull forward of demand in certain parts of consumer spending, and this was one.
This is the reason why I'm looking at Target shares in pre-market trading down 1.6%, Lowe's shares down more than 3%. The sympathy trade here points to something that is larger than just a Home Depot story. And perhaps this is just because people are jumpy, but really any kind of forward look that perhaps there was this bringing forward of demand that now is cooling at a rapid pace is concerning for people who, again, keep leaning on the consumer to defy all expectations of weakness.
So I think the first two questions you and I both had, is this up and down the income brackets? Does this go beyond goods to services? Because services has been really robust. We were talking about the airlines through this week, and airline spending. Anyone who's been to an airport knows that things are booming right now, Bramo. Does that start to fade as well?
This is really the issue for a lot of people. And I know that, for example, Ed Yardeni's been talking about the disinflation that is expected to happen at an increasing pace. This is what the stock market's banking on, that this will actually cause a massive disinflation that will allow a soft landing. And this is the reason why things are going to end up being much better than all of the naysayers and bears out there say.
I don't think you can do a static analysis. Yes, disinflation is going to lead to a lower nominal GDP, some pressures, including on retail, but all in all, it's ambiguous. There's going to be other advantages there, and I'm going to go to the optimism of someone like Neil Dutta that says, hey, you know what? Less inflation, actually better inflation-adjusted incomes across the many deciles of America. So it cuts both ways. I do a more dynamic analysis there.
So where does that leave the Federal Reserve? We've got a range of views in the last 24 hours. President Kashkari, we have a long way to go before we get inflation back down. On the other side of things, I would say President Goolsbee of Chicago, indicating that May was a close call for him. Speaking to CNBC in the last 24 hours. We have a long way to go over in Minneapolis, over in Chicago. I think we need to be extra mindful. Two different views there, TK, at the moment.
Yes, it's really important. I'm glad you brought this up. We made a joke yesterday. There's 432 Fed speakers this week. Got some traction, but they're all different. And Goolsbee has a character and mindset, I'm going to blame it on the giant Gary Becker at Chicago, of looking at a more complex, holistic analysis rather than the algebra of two plugins of our start.
The bottom line is everybody's pushing back against the idea of rate cuts before year end. And the market's sort of buying it, kind of moved a little bit yesterday, and then kind of retraced some of that. So I think your point, John, about what role does Jay Powell have to play in basically putting a cap on this, saying we don't care what happens, we're not cutting rates. I mean, again, that will be a read my lips kind of moment, but still.
Just starting to see this subtle splintering, aren't you, between Fed views in the last 24 hours. And I said this earlier this morning, I put the emphasis on subtle. It is really subtle, but I wonder if this is one of those weeks where the chairman has to come out and get hold of the narrative. Should we do the debt ceiling stuff? I know you love this, TK. Compare and contrast this. Brainerd, formerly of the Federal Reserve and now at the administration, over the weekend, talking about the debt ceiling negotiations at the staff level. Said the staff are very engaged. They characterized the engagement as serious, as constructive. Kevin McCarthy, the Speaker of the House, coming out and saying this: we're nowhere near reaching a conclusion. He said that ongoing staff level meetings are not productive at all. The talks so far have not produced, Tom, quote, agreement on anything. That's kind of the groundwork. How the stage is set a little bit later for talks between the Speaker and the President.
To look at the Republican side, the only time there's going to be agreement is when somebody goes, we can't cut the Social Security check in Kentucky or Florida, and name a bunch of other states as well. And you can take it right over to the left as well. That's the sole catalyst I've ever witnessed.
Next stop for this market, 8:30 Eastern Time. U.S. retail sales right now in the equity market on the S&P 500, negative by not even 0.1%.
It's come back.
Home Depot is negative 4%. I can tell you that joining us right now is Ed Yardeni of Yardeni Research. Been looking forward to catching up with Ed this morning. Ed joins us right now. Ed, let's talk about this. Are there reasons to be bullish this morning for you?
Well, I think that the economy has been proven to be quite resilient. We have been in a recession. We've discussed this before. It's been a rolling recession. And notwithstanding that, consumers continue to spend. Multifamily housing continues to be built. And then we have a lot of infrastructure spending that's still ahead of us and onshoring. So put it all together, we have an economy that's faring remarkably well.
Ed, you had a resiliency to be in the equity markets, given your economic analysis. It was pretty grim last October into November. And you said, look, the gloom is just not applicable. Is it applicable now, or can you still stay on board American equities?
Well, I thought in late October that we might have made a low on October 12th of last year, and that was mostly because I saw a tremendous amount of pessimism out there, as much as there was back in early 2009. And surely things aren't anywhere near as bad as they were back then. I mean, maybe I'm wrong about that. Maybe this banking crisis will morph into something as ugly as that, but I certainly doubt that. And so I think that, as Chauncey Gardner once said in the movie Being There, the book too, in the spring there will be growth. A lot of forecasters were anticipating an economy-wide recession by now. They were expecting that earnings would tank, and the second quarter earnings season's gone fairly well.
What do you make of this idea of a discretionary recession that we're beginning to see, perhaps in the earnings of Home Depot, perhaps in the earnings that we may get throughout the remainder of this year?
Well, I think we have had a recession in the goods sector. Consumers pivoted away from buying goods to buying services. And as a result of that, retailers got caught with a lot of inventories that they didn't expect that they would have to hold. And so they discounted and they stopped their ordering. So there has been a recession in the goods sector, I would say, for about 6 months. I hope this is the tail end of it, and we'll see how, as you said, the Home Depot issue suggests that we're not out of the woods yet with regards to goods. But people are traveling, the airports are busy, the restaurants are packed. A lot of baby boomers my age are retiring, and what do they do all day? I guess they play golf and they go out to eat, and they travel.
Well, Ed, as they travel around and go out to eat, there is this sort of divide between those who see this as a more persistent inflationary input for longer, and those who see this as something that simply supports the economy while other areas disinflate. That's sort of the wonderful life scenario that you put out there. How do you draw the distinction? When do you say, okay, people who are just retired and playing golf and traveling around all day are going to boost inflation to a degree that's going to be uncomfortable? How do you push back against that?
Well, I think it is going to turn out that the truth about inflation is somewhere between transitory and persistent. I mean, it's definitely been transitory on the goods side. We've kind of round-tripped on inflation there, particularly in durable goods, but even in non-durable goods. Even food inflation is moderating, and people thought that that would persist. Transportation costs for hauling around food and other commodities and goods, that inflation rate's come down dramatically. So we're still stuck with the services inflation rate. A lot of that is rent. We know the rent inflation is already coming down on a 3-month annualized basis. And then we've got that kind of sticky core super inflation rate, whatever the Fed likes to call it. I think that'll moderate. I mean, that's the one that's hard to predict. But I think if you got disinflation kind of across the one area, it'll disinflate too.
Let's have a Ed Yardeni Yale question right now on monetary theory. Can a central bank have as part of its management financial stability? There seems to be a primal call for central bankers to do more than in the U.S. inflation and jobs. Can they actually manage, as doctrine, financial stability?
Well, I wish that the dual mandate was only one mandate. Central banks really should just focus on financial stability. If we have financial stability, I think it implies that they have to keep inflation down. I think financial stability is good for the labor markets. This dual mandate that we have, I think, doesn't have its priorities straight. And the other central banks are also have as their top priority keeping inflation down. And I think making financial stability the top priority would do that as well. The Fed, as you know, just put out a financial stability report, and it was remarkably calm. They didn't seem to be fazed at all by the banking crisis. I hope it's not arrogance on their part. They seem to believe that they've managed to contain it and that they've done a good job there.
Ed, appreciate your insight. Always enjoy listening to you. Ed Yardeni there of Yardeni Research. I think we all hope the Fed's not being arrogant right here. What sounds so bad about golf all day? I think that sounds great.
I think that sounds great too.
Great.
No, I mean, when we get to retirement, can I just say, why do we call it financial stability when markets go down, but not when markets go up? I mean, for 10 years, when markets were going up in an unsustainable way, nobody was saying, I'm worried about financial stability. They should really get monetary policy in line with it. But all of a sudden, markets potentially could go down and there are risks, and then all of a sudden it's an issue.
Wasn't there a whole institution of perma-bears that was saying exactly that for like a decade?
Yeah, they were just wrong. So maybe that was the issue. But, why are people calling on the Fed to respond to that? Just saying.
TK?
Perma bears for a decade. That's a really core. It is tough to be permanently bearish. It is really
You're telling me.
You get to sound
Really
smart for a
difficult.
long time, though.
Nah,
Every
not
10
anymore.
years, you're brilliant. No, seriously, Joe Granville
It's true.
101. Every 10 years, you're brilliant.
True. I
You
agree.
know, that's all there is to it.
Equity futures on the S&P, negative by 0.1%. Isaac Bortansky give BTIG on the debt ceiling coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden meets with House Speaker Kevin McCarthy and other congressional leaders again today to try and avert a default. McCarthy says the two sides are nowhere near a deal to raise a debt limit. The standoff has been roiling markets as investors bet whether an agreement can be reached. There's a sign that economic uncertainty is now leading to a pullback in home improvement spending. Home Depot cut its outlook for the year after the first quarter sales dropped more than expected. Comparable sales were down 4.5% the first 3 months. The company says earnings could fall as much as 13% this year. It's another sign that former Vice President Mike Pence is preparing to run for the Republican nomination for president. Pence's allies have formed a political action committee to support him. Pence has said he'll announce before late June whether he will challenge his former boss, Donald Trump. Ukraine says its air defense system defeated what it called an exceptional Russian missile blitz overnight. Now, the attacks included 6 hypersonic missiles that were aimed at the capital city, Kyiv. Ukraine says it destroyed 18 Russian missiles. Bloomberg's learned that U.S. regulators will challenge Amgen's $27.8 billion deal to buy Horizon Therapeutics. The FTC is expected to file a lawsuit today. It'll argue that the combination would hamper innovation and slow the pace of drug development. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The Fed coverage you're looking for. Today, an exclusive interview with Richmond Fed President Thomas Barkin.
Everybody's got a recession playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound.
Then Bloomberg's Michael McKee speaks with Chicago Fed President Austin Goolsbee.
We should gather further data, and we should be extra careful about raising rates too aggressively.
The most in-depth coverage and analysis of the Fed, right here on Bloomberg, your global business authority.
staff is very engaged. I would characterize the engagement as serious, as constructive. When I talk to CEOs, to business leaders around the country, they tell me things are actually going very well.
We're only a couple weeks away, but if you look at the timeline to pass something in the House and pass something in the Senate, you got to have something done by this weekend. We are nowhere near any of that. I appreciate the president sliding into talk after 97 days, but there is no move.
Compare and contrast, Lael Brainerd there, the National Economic Council Director, speaking on CBS with House Speaker Kevin McCarthy on the same issue, saying very different things about the direction of travel going into talks between the President and the House Speaker a little bit later on this afternoon, around about 3 p.m. Eastern Time. Later on this morning, retail sales in America, 8:30, 1 hour and 13 minutes from now. We've got a flavour of what's happening in retail from Home Depot a little bit earlier. Cutting their outlook, the stock is trying to bounce. We were negative 5%. We're now negative just 3.2% in early trading, down to about 279 on that stock in a pre-market. For the broader market, we're negative 0.1% on the S&P 500. TK yields come in, fall down just a little bit by 2 or 3 basis points through the curve. Two's out to 30s. On a 10-year right now, we're down about 2 basis points to 347.75.
Modest surveillance correction, but we always correct when we're wrong, and I was wrong. Home Depot, I'm assuming, leading over the last 10 years. Lowe's has outperformed Home Depot in a per-year share return. I would not have guessed that.
There we go.
That's a really different part to the mix as well. Right now in Washington, and we're going to try to take a different spin here. Isaac Boltanski joins us, Director of Policy Research at BTIG. Exquisitely good on the distillate of when we're done with this. Isaac, first question. The morning after this is fixed, what happens?
We go on to fight about other things, Tom. You know, then the morning after, then we're going to refocus on whatever the next big legislative deadline is. And that may be the spending bill at the end of September, it may be the farm bill. But when we get this off the table, I think the market can go back to worrying about everything else, because the debt ceiling is so important.
Look, Isaac, and this goes back, folks, to Pete Peterson, the gentleman from Nebraska who called me up. He was quite elderly at the time, and he and I talked about his ageless concern, Isaac, where the former Secretary of Commerce made clear he was forever worried about this debt. The Peterson Foundation publishes that CBO interest expense over the next 10 years will go from $640 billion to $1.4 trillion. That's the interest expense. Every American knows that's nuts. Why shouldn't we be concerned about this?
We absolutely should. We absolutely should. But DC has an inability to focus on the long term, right? We are focused definitionally on short-termism. And even when we have these discussions regarding the debt ceiling and maybe spending, we've already taken off the table talks about addressing long-term entitlement reform, which is, we know, is one of the larger drivers of our debt. And so we've also taken off the table defense spending and other items. And so when you start with so many sacred cows, it's impossible to actually get anywhere over the long term. So the most we can hope for, Tom, from these negotiations is just not shooting ourselves in the foot with a technical default and having to go through the mess of prioritization and whatever else may come from not doing the basic job of lifting the debt ceiling.
Isaac, I'd love you to build on what Wendy Schiller was talking about at Brown University earlier this morning when she said that in our ultra-polarized world, she expects things to sort of be a repeat of 2011 in a bit, but with a less satisfying legislative solution, basically saying that Republicans tend to want the government to go into some sort of default or at least some sort of non-payment because it plays well in terms of them taking a hard line on spending. Is that true, or is that not really borne out in your experience?
I don't think that we're there yet. And I'm still operating under the old maxim that things in D.C. are impossible right up until the point that they're inevitable. And I do hope that we're able to get some progress today where we're able to move forward on that list of menu items that we've all seen reported about over the past few days, to the point where perhaps President Biden leaves his G7 meeting early or skips Australia and some of the other stops, comes back, has a one-on-one with Kevin McCarthy as early as next week. And then at least, and my base case here is, we just have a deal that pushes the debt ceiling deadline to the end of September, which then aligns it with the federal spending deadline and gives negotiators a little bit more time, because look, they're trying to solve some pretty thorny issues, when in reality, you got to have something starting to move its way through the legislative process by the beginning of next week.
As we wait for paint to dry and get a sense of when things get to be a little bit more urgent, we're going to have the hearings with respect to what happened with Silicon Valley Bank and all of the regulatory oversight. We already got a look at some of the pre-released questions from the former CEO of SVB, blaming the Fed, blaming regulators, blaming social media. What do you expect the response to be?
Look, the reality is hearings very rarely change the policy trajectory, and we need investors to know that the regulatory framework is going to be tightened for banks. They're going to start with super regionals for their total long-term debt requirements and resolution requirements, and then they're going to go down to the 100 billion plus bucket and start to deal with things like AOCI. But my issue here is I don't think this banking crisis is over. I think it's going to flare up again. And what we're going to have to deal with when we look at the post-mortem for this crisis is what was the logic behind us tying the hands of the regulators on the front line to address these crises? The FDIC has nothing else it can do administratively to address this deposit insurance issue. So once again, we're waiting on a Congress that's either unwilling or unable to act on the matter. And frankly, that scares me because we're not through the woods yet on the banking issue.
Well, Isaac, let's tease out a little bit more of that. What about the tension in the last couple of months do you think has the potential to flare up again?
Look, I think that we have not addressed the mismatch of assets and liabilities across the banking system. I think that we have not dealt with some of what I think we can all agree were supervisory failures. And we spoke earlier about the Federal Reserve's mandate, and the Federal Reserve is also going to take some flack here. There's a hearing about Federal Reserve reform later this week, worrying that perhaps their guiding star is just monetary policy, and that leads them to fall down on their job as a bank supervisor sometimes. So I think that's still out there. And look, I listened to Jamie Dimon when he also says that he's concerned that it's not over. So I put all of that together. I put into that mix the fact that you still have some policymakers talking about the need for a short selling ban on banks. And I look and say that our option set for addressing another flare-up, especially if it's in a bigger, more systemically important bank, is pretty limited to just Congress passing legislation quickly. And they're not good at that.
Isaac, thanks for the perspective. Isaac Botansky, the brutal honesty there at the end from BTIG. Just on the debt ceiling, this is the closest the US government comes to behaving like European governments. And that's not a compliment. Just this idea that you need a crisis to get a solution. Seems to be the European way for a long, long time, specifically for the EU, that you have to get closer and closer to this crisis moment to get the solution you're waiting for. And by crisis, we're talking about market tension that just isn't there yet in a major way.
And new to America, and the Pew Research has this out in the last number of days. They had a wonderful tweet on it, and I don't have it in front of me to do it, but the bottom line is the new polarity of America between right and left is something unique, even compared to the European nations. I noticed the polarity versus France was much greater.
Well, we've gotten to the point where Isaac Boltansky comes out and says that requires legislation, which they'd have to pass quickly, which is something they're terrible at, which is basically a sense of the dysfunction that everyone keeps talking about in Washington and what ends up getting legislated by some of the rank and file who work at the Fed, who work at the Treasury, who work at these departments because of an absence of legislation and action in the congressional
I take real issue with the people that say this is new. There was a period where I woke up in my 20s and realized how dumb I was about American history, like 1880, 1890. And pre-Teddy Roosevelt, I mean, it was like this, John. It was tight battles day to day, week to week in Washington.
But Lisa's point, look, they sit there in their rooms, I imagine. I'm not saying this happens, just my thoughts. You get 2 points for passing legislation, you get 3 for fighting, and fighting's easier. The life of a politician in Washington, D.C., right?
Pretty good equation. I think that that's fair, and I think that that's what keeps on happening. I think that there is a slight shift.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Let's work through the market action this Tuesday morning. Good morning and welcome to the program on TV and radio. This is Bloomberg Surveillance. Your equity market looks like this on the S&P. Negative by 0.1% on the Nasdaq, down by not even that much. We're down by 0.05% on the Nasdaq 100. Snapping a two-day losing streak on the S&P yesterday with some marginal gains. Into the bond market, 2-year, 10-year, 30-year. Yields come in 3 basis points on a 2-year, 397.90. Basically the average of the last 30 days is a little north of 4%. Not too far off that. The average at a 10-year in and around 350. That's where we are now, 347.75. It's the bumpy road to nowhere in both the bond market and the equity market over the last month or so. Note to the morning goes to Tony Dwyer of Canaccord Genuity. Catch up with Tony in about 2 hours from now on Bloomberg TV. Here's the quote, Tom, and I know you've read the note as well. He's been speaking to clients, and he says the following: they are hesitant to get optimistic given the macro backdrop and increasing likelihood of recession, nervous to become overly negative given the damage that has already been done underneath the surface on the S&P 500.
It's a really good note because it talks about the behavior in a collared market. We have the conflation of moving averages now down to a single point. And Dwyer says the market is fine, F-I-N-E, frustrated, insecure, neurotic, and emotional. Sounds like this, it sounds like our
Bramo's
staff.
newsletter, isn't it?
Yeah, the newsletter's called Fine.
brew.
The Fine newsletter.
Everything's fine.
Insecure, neurotic,
it's a toxic
and emotional.
brew. But
There you are.
within this, Mr.
boy.
Dwyer really hits on a point, which is the behavioral characteristics. It's not
Certainly declaring they are done for. The damage done, was it last year, the price we've got to pay for it? Was it 30% on the NASDAQ? Is it more than that? Do we have to see unemployment go up 100 basis points? What's the time horizon for them to get back to inflation numbers of 2%, say? And this is the issue. You're nervous at the moment to go long. At the same time, you're a little bit hesitant to get short.
It's a really annoying market. I mean, I think that that's correct. And Stuart Kaiser put it well, which is basically, it is annoying because basically people aren't that bearish. They're looking at the market. They're seeing some positive signs, yet they don't believe that they're going to get rewarded as much as just simply going into cash and getting 5%.
I know we got to move the show forward, but I think this is incredibly important. The percentage of people that participate in the recovery out of October, as Ed Yardeni mentioned, and the huge number of people that aren't in the game right now and missed that recovery out of October. Two different annoying behaviors.
Look, everyone sounds like that classic two-handed economist, right? One hand this, the other hand that. Look at the Bank of America Fund Manager Survey this morning. You can see the gloom and you can see the optimism too. In the gloom, global growth expectations, worst levels of the year. In the rotation, out of commodities into tech stocks, defensive. You can see this across the board. The most crowded trades right now, long big tech, short banks. That's pessimism right there. Here's the hope. The majority of investors still hoping for a soft landing rather than a hard one. The vast majority of investors expecting the debt ceiling resolution before the ex-date. And a survey of participants in this survey, here we go, forecasting just a 1% drop in global EPS in the next 12 months.
this is what's really keeping things supported and why people are getting burned out of every bearish trade that they possibly can. And this really raises a question about the consumer and how long that can keep upholding it, which is what we saw in earnings. If you take a look at Home Depot, we've been talking about that all morning when they came out, cutting the outlook, and it really is about outlooks going forward, saying that sales were going to be a lot lower. Those shares have clawed back losses that at one point were almost 5%, now down just 2% as people parse through those earnings lows. It's a comparable competitor, I should say, is down 2.3% in sympathy. And this really raises this issue. Is this just simply a housing-specific kind of area, or is this broader retail weakness? If you take a look at the other companies that are going to be reporting, TJ Maxx as well as Target, both tomorrow, as well as Walmart coming out on Thursday, all of those shares are down in sympathy, but not that much. Target seeing the biggest declines given the fact that they've had a bit of, I don't know, should I just say volatility in their results over the past few years.
Yeah, particularly Target.
Yeah.
Was it last May? That was just ugly. Was it last May? I think it was.
Yeah, but it was like a couple.
Yeah, we had a few of them.
Revisions that were pretty problematic.
Lisa went through the earnings from retail this week. Of course, Target tomorrow, Walmart coming up on Thursday. 8:30 Eastern time, we get retail sales for the United States, that data point for the previous month. Later on this afternoon, 3 p.m. Eastern time, Biden and House Speaker McCarthy set to meet today on the debt limit. Lindsay Rosener of PGIM Fixed Income weighing in on the market reaction, writing the following. There's a kink in the T-bill curve around the X-date with 100 basis points of extra yield. If we don't get a resolution, we're just kicking the can down the road and not eliminating the problem. This makes the T-bill market, Tom, a challenging place to be.
Really good note from someone really qualified to talk about this, and of course with all the hierarchy of PGIM and the excellence they've done over the years. Ms. Rossner joins us right now. Lindsay, the note really goes to the opportunity that's out there. What is the opportunity given a discontinuous function in the 3-month T-bill? How do you play it?
Right. I think the answer is you don't play it. There's so much talk right now about getting this extra 100 basis points. But if you think about it, the downside, if we actually do have a default, which we think happens with a 5% probability, 100 basis points is just not good enough upside downside analysis. So for us, it's skip the games in the front end of the curve and get more into the intermediate duration space where you can take advantage of doing the right kind of things.
I mean, what's so important here, Lindsay, and this is to the elasticity or responsiveness of the belly of the curve, 5 to 7 years, I'll call it as well. Then what's the opportunity there? How do you play that?
I think there are a lot of opportunities, and you can go kind of any which way you want. So if you want to be more conservative, you want to stay more investment grade, great opportunities in agency mortgage-backed securities, even commercial mortgage-backed securities if you stay high quality. Top of the cap structure, AAAs with a lot of credit enhancement. There's good stuff to do in investment grade space, a lot of opportunity there. But if you want to seek more risk, go for more yield, there are idiosyncratic opportunities in high yield. So you've got kind of a diner menu of options in the middle of the curve, and you don't have to get stuck in this noise or the anxiety that you all were speaking of in the very front end of the curve. That is really hard to play. And the big problem is that if the debt ceiling, if the quick solution is prioritization, that's just kicking the problem a month, 2 months down the road. You're going to be right back in it. And so if you thought you did something cute and you bought T-bills 2 months out, well, you may now be back at the X state before you know it. And it's just not a game worth playing.
Okay. That said, if this, let's say, gets resolved, do you then get more risk on? Do you start to get more aggressive in other areas that go beyond just simply the idiosyncratic trades?
So we go back to, with your prior catch, you're asking, okay, this gets resolved, what's next? And the what's next is we go back to what we were concerned about, which is we still have the central banks across the globe that are trying to fight inflation. And there are parts of the globe where we still have double-digit inflation. So this battle isn't over. And we need to think about how does the curve respond. Right now, we all know that there's a significant amount of cuts priced in the U.S., for example, at the end of the year. How does that work out moving forward? And so we go back to inflation watch. We get out of debt ceiling watch and we move back to inflation watch and figuring out, is a recession happening? Will it be a soft landing? And in that scenario, it still isn't yet green light risk on.
We've been talking about that Bank of America Fund Manager Survey, and one aspect of it was that allocations to bonds are the biggest going back to 2009. This is the latest one from May. How much does that give you a sense that things are crowded in the duration trade? Basically, this idea that longer term there is a confidence that we're going to be low inflation, low rate kind of, trading the same way that we were over the past few decades.
I think what we've got here are some big shifts in asset allocation or portfolio allocation. Forever, there was the discussion of the 60-40. 60-40 is not really working. If you have a move to this 50-50 or even more fixed income, that then tells you that these flows make sense and they are stickier than one may think. Also, as we've been saying all year, you've got income and fixed income. This isn't a place that you just park it because you're scared. There's a lot to earn here. And so I think that movement into fixed income is well-founded. I'm obviously biased as a fixed income manager, but I think it makes a lot of sense now, and it didn't make much sense for a very long time.
Do you think the allocations are just generally increasing in a structural manner to fixed income and decreasing to equities so that it might be more of a 50-50 kind of new portfolio?
I think time will tell. I do think it's moving in that direction, and I think that direction makes a lot of sense.
Lindsay, got to wrap it up there. Always enjoy your insight, particularly on the debt ceiling. You know, for once, we're actually having some intelligent conversations, Tom, on the debt ceiling this morning. Wendy Schiller offering her view, her opinion. Lindsay Rosner there on the bond market.
Yeah, no, I think everybody in the media is struggling with this, and some go from the emotion of, oh, he put his elbow down on the edge of the Oval Couch. What's it mean? No, we're going to try to talk to real people about this, including CBO.
Just kidding.
We're going to fold in the work of CBO and the industry in Washington that's got a real long-term concern about this. It's like we've been crying wolf on this for how many years? Someday the wolf's going to show up.
I'm with you.
Period.
But right now, that's not the view, is it? The consensus view is
that is not the view.
Gets dealt with, and I know that you share that view deep down.
And the R-star is lower, and things are wonderful, and it's morning in America.
Talks again, 3 p.m. Eastern time, a little bit later on this afternoon. Home Depot recovering a bit here, Tom. We're down 2.4% in the pre-market.
And this is unusual. I want to sell this, and I want to be sure it's more important at 9 o'clock to listen to John Farrell on Bloomberg Television than to be on the HD call. But the sell side is saying this call really matters, not only for Home Depot, but the tune of it. And Steve Zaccone over at Citigroup just says, the language that these guys use in pressure when they're writing, I love this, updated quarterly margin cadence.
What does that mean?
I have no idea what that means. We got to get Zaccone on to talk about it. But that's the kind of language you're seeing here at 7:40 a.m. into an important 9 a.m. Conference call. Lisa mentions TJ Maxx. I'm looking at the Buffon and Broken Heart Glam Cheetah outdoor water resistant picnic beach blanket.
Well, we were talking earlier today, though, about margins and how long can margins continue to actually expand. We saw the first margin expansion on net from S&P 500 companies that have reported going back a year and a half. How long can that continue if consumers really are pushing back? So then all of a sudden you have to think from a corporate perspective, things perhaps look less good, and some of the celebratory shifts that we've seen in the stock prices might not be as warranted. This is sort of one of the bearish
Next stop for this conversation, 8:30 Eastern time for U.S. retail sales. Now, imagine you run a bank, and you're running that bank, and you rely on one thing, not your team around you, but Fed speak. Fed speak is literally the thing that you rely on. The whole model. It's just like, whatever they say, whatever Powell said, he says it's transitory. That means I'm going to build my business around it being transitory and low rates forever.
And they're not going to ever raise rates, and so they don't have to hedge duration. And that's going to be the CEO's argument from SVB.
Did that work out? David George of BED on the banking sector. Great voice over the last month or so on this topic. The stress of the last couple of months in regional banks. He's coming up shortly. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House and congressional leaders head into another session of debt limit talks today to try and avoid a default. President Biden has said he was optimistic a deal could be reached, while House Speaker Kevin McCarthy expressed that ongoing discussions were not productive at all, and leaders are nowhere near reaching an agreement. The former CEO of Silicon Valley Bank says the Fed and social media contributed to the lender's collapse. Greg Becker testifies before the Senate Banking Committee today. He's expected to blame the fastest pace of hikes by the Fed in decades. According to his prepared remarks, Becker also will point a finger at negative social media sentiment. A special counsel faulted the FBI and Justice Department's probe into whether Donald Trump's campaign conspired with Russia in the 2016 election. Still, John Durham failed to issue any new charges or recommend significant changes to investigative procedures. The former president had claimed that Durham would reveal a conspiracy to undercut his presidency. Global oil demand will rise more than expected this year because of China's post-pandemic rebound. That's according to the International Energy Agency. The IEA says world fuel consumption will rise by 2.2 million barrels a day to a record 102 million. The agency expects demand in China to hit an all-time high. And a group of senior officials from Tesla are visiting India this week, looking to expand its supply chain beyond China. The visit would represent a thaw in the relationship. Tesla CEO Elon Musk has criticized India's high import taxes and its electric vehicle policies. India has advised Tesla not to sell cars in the country that have been made in China, its political adversary. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. The biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
We at the Federal Reserve probably have more work to do on our end to try to bring inflation back down. And most importantly, we should not be fooled by a few months of positive data. You know, we still are well in excess of our 2% inflation target, and we need to finish the job.
Neil Kashkari, pretty consistent on the issue around inflation over the last few months. The Minneapolis Fed president weighing in, tons of Fed speak this week. I've gone through the names already. I won't do that again to you, but it concludes with Chairman Powell at the end of this week. For the broader market, we are negative 0.16% on the S&P 500, just a little bit softer to start your morning, a bit defensive, captured by that move in yields lower on a 10-year, 347.75. Home Depot recovering just a little bit. It was down 5%. We've cut those losses in half. We're down 2.4% right now on Home Depot. Retail sales in America, Tom, just around the corner. Let's say 43 minutes away.
Retail sales will be important. I'll be looking at Control Group, which really breaks it down. Jen, I really want to emphasize there's like 7 retail sales reports that come out at once. And I do take the distillate out building products, out gas, out this, out that. And it's the Control Group. It'll be interesting to see what that metric is.
And that read gets plugged into GDP, Tom. When we get a few more reads
if
of that.
McKee says it does, it does. I can't get there, but McKee says it does that, right? And there's productivity as well. Futures, can we say that the tape is recovered from the Home Depot shock? I think, it's a little bit. recovered.
Yeah, we've bounced off the lows, Tom, and we'll see what we get on the call, and then we'll see what we get from Target, from Walmart, and the overall figure a little bit later at 8:30 Eastern.
We'll see what we see. In banking, we will see what we see forward with not only the financial statistics and all the studies Lisa's reading in the afternoon when they slip out, but also what the executives of the failed banks say. David George joins us now, Senior Research Analyst at Baird. David, I'm going to break a rule. I'm not going to go to 4 accounting statements. I want to go not so much to the behavior, but the verbiage that we're getting from failed bankers. To me, I've made this very clear on air. They were basically marketing experiments wrapped around the gauze and protection of your banking system. Are you put back by the comments we're hearing? It's the Fed's fault. It's the San Francisco Fed's fault, et cetera.
Yeah, it's hard to, Tom, and good morning. Thanks for having me. It's hard to buy into that commentary with a lot of weight, at least from my perspective. And it's easy for me to say from the cheap seats on the sell side here. But clearly, bank management teams, CEOs, CFOs, Treasury departments are paid millions of dollars to manage risk for shareholders, for their customers, for their various constituents, et cetera. So I think that's a kind of a soft excuse from my perspective.
I'm going to go to Nassim Taleb, where he says all that matters is skin in the game. Once again, and this goes back to Frank Quattrone 101 from a million years ago, David George, these guys were compensated off growthiness up the income statement at the revenue line, for example, rather than growthiness of profit. Is that correct?
Yeah, that's right. And we don't cover Silicon Valley, to be clear, but one common denominator, Tom, of all of these banks that have failed is that they have grown very quickly. Banking is not a growth business. It just isn't. So it is going to grow typically at a GDP rate, maybe plus 100 to 200 basis points. And one common denominator of these failed banks is they grew very quickly. And there's some regulatory oversight issues that I think probably need to be addressed, but in particular, the deposit funding mechanisms for these companies, a very chunky deposit base, which poses a lot of risk when there's fear in the system. And I think that was also another common theme of the banks that have failed.
Is it over?
I think we're pretty close, Lisa. Again, from my vantage point, we don't cover PacWest or Wall. Those are obviously ones that if we turn on your station and others that gets a lot of publicity. It appears that the liquidity situation in the system is pretty good. And from my perspective, if you haven't changed banks by now, you're probably not going to. And so we're of the view that the vast majority of the deposit movement is behind us. The results and updates that we've gotten, Lisa, so far here in the second quarter from many of the kind of more established regional banks has actually been pretty good. So as cooler heads prevail through the balance of 2023, we actually feel pretty good about where we are, and we think we're in the later stages of this episode of whatever you want to call it.
Which gets to the sort of existential question of what this crisis, or whatever you want to call it, has been. Is this really an issue of deposits leaving the system, or is this an issue of profitability when you have to pay up for those deposits? Now, I was reading this Georgetown professor's comments, who is saying the biggest problem is confidence, and I am not sure how you build that back. It is not going to just be deposit insurance. So how far away are we from building that confidence that not only can you put your money there, but you can get your money, you can get good interest, and oh yeah, this company is actually going to deliver returns?
Yeah, I think what's happened in the last 6 to 8 weeks is what we would have expected, Lisa, to occur over the next 6 to 8 quarters. I think it's very important to have an intermediate to longer term context about bank deposits and liquidity. If you were to take a look at bank deposits or demand deposits or checking accounts as a percentage of total funding over the last 50 years, it's around 25 to 30%. And the response from COVID, both fiscal and monetary, resulted in significant overages of deposits, and that number got up to 40%. So and we view this sector through a normalized lens. I think you have to do that as it relates to credit, liquidity, margins, et cetera. And all we're seeing is just a normalization of liquidity. And bank deposits are not going to zero. They're over $17 trillion, and companies have significant operating accounts that are going to stay in the banking system. So that's something that just happened a little quicker, and profitability, we think, is going to get much better over the next 6 to 8 quarters as banks can reprice those assets upward.
David, Robert W. Baird is Milwaukee, First Wisconsin, and all the rest of the heritage of Milwaukee finance and investment. I'm absolutely fascinated by, within all your connections within Baird and across Wisconsin. Is there an urge to merge among bankers, or are they just too comfortable with the status quo?
Well, it's going to be interesting to see what happens. We're of the view over time that you're going to get more deals. And I think a lot of bank management teams are sitting here today thinking about the future, thinking about this episode and the risks that emanate from what we've lived through over the last couple of months. So we're of the view, and I think Janet Yellen has expressed a more of an openness to deals. So it wouldn't surprise us to see some MOEs or some larger bank deals over the next couple of years. I think we need to get some clarity, Tom, as it relates to credit. But clearly, I think the secular trend for more M&A is clearly in front of us for sure.
David, I just want to put a bow on something. It's how you started this conversation. Do you think people are continuing to overstate just how flighty deposits are? Do you still think the deposit base at most banks is still really, really sticky? Has it changed so much with the proliferation of internet banking over the last 10 years or so?
Yeah, I think it is pretty sticky, and it is not as sticky as it was maybe 30 years ago. But at the end of the day, it's important, particularly for small and medium-sized companies. Commercial banks and regional banks in particular are the lifeblood, John, of basically the capital system, and provide significant liquidity, payroll, cash management, treasury management services to all of these companies. And they provide a meaningful and valuable service that I believe they should be paid for, and they will be paid for over time. So it is a relationship business, particularly on the corporate side. And I think that's something to remember. Whereas I think Silicon Valley, Signature, some of the others are maybe a little bit more transactional, and that's where you have a little bit more risk.
David, thank you, sir, for your perspective. David George of Baird, just a sensible voice on a difficult conversation. Just on the deposit base, I get that some things have changed. I think we all understand that in the last 10 years. Internet banking is a much bigger thing, the ease of opening an account, understand all of that. SVB is a really bad example of it. If you have more than 90% of your deposits uninsured, by definition, they are massive in size.
Not a real bank.
If you see loads of money go out of the door really quickly, how many hands full of money are you seeing run out of the door really quickly? You're just seeing a few big customers go out of the door.
It's not a bank. I
get in trouble with this.
I'm going to get.
We can have that debate another time. It's a very different bank, TK. It's a very
Yeah.
different financial institution.
I have a tattoo here. I liked it, but over here I got Lula from Brazil because I was so wrong on Lula. Right under here, it says, and a banker told me this years ago, and I was incredibly wrong on the fold-up of the small banks. Tom, I like to go to lunch. And that's what the guy said. And so much of the lack of mergers in Gerard Cassidy and David George's world is literally people like to get up in the morning with their board, their golf buddies, their Rotary members and they like to go to lunch or maybe a breakfast before it. It's a hugely behavioral thing across America.
I'm not sure how many lunches have been had.
I don't think it's the same in England. Is this the same in England? Is it the same in England where there's lots and lots of little banks?
It used to be that way, Tom.
And it's gone.
They're going to lunch, they're playing golf.
Small banks all over, dotted all over England.
The branches have all been shut down, or the branches have been closed down.
We're still living it.
I know. About 20 years behind, I've said that repeatedly.
Yeah, or
US
more.
banking, behind Europe, particularly the Scandinavian countries. I mean, they're basically cashless societies, some of those countries are now. Anyway, that's a different topic. On the S&P 500, negative 0.1%. Retail sales, 34 minutes away.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and
it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Leaning towards the bond market view that we're in for some volatility.
We're kind of bouncing into a ceiling at a floor, effectively.
We think the market's a little bit generous in terms of Fed cuts coming.
The Fed has done a very good job of continuing to support the economy while raising rates and trying to tame inflation.
I'm in the camp that it's not going to go neatly back to 2%. I think there's another upside surprise waiting out there in the inflation data.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A Tuesday of retail sales in this hour and the productivity of America. John, retail sales front and center after Home Depot.
Oh, without a doubt. Home Depot a little bit lighter, softer, negative in the pre-market, but phrase of the morning so far from Chuck Grom of Gordon Haskett. Discretionary recession is his call, Tom, going into retail sales later this morning, on to Target tomorrow, Walmart after that.
And the mystery and the character of recession, we're still modeling numbers. I think of Lindsay Piegza the other day, the idea of 2% real GDP. That's not what we see here. January booming, February, I don't know. But into March and April, there seems to be a real mystery about the state of the consumer.
Captured by the rotation in the equity market and the outperformance of tech so far year to date. The Bank of America Fund Manager survey out earlier this morning. Tom, we've talked about it a few times. Top 2 crowded trades right now, long tech, short banks.
Yeah.
That's been the rotation away from the commodity cyclical stories towards, say, the big tech names. That growth story again.
Tony Dwyer with John Farrow in the 9 o'clock hour. That's important as well. Lisa, I want to get to this quickly because we've got a fabulous guest for Global Wall Street to get us started in this 8 o'clock hour. But Lisa, I look at all of this and it's almost a joy in that the debt ceiling debate drifts aside. We had slower data in China, slower data from Home Depot, and there's sort of a stew within the collared trade we're in right now.
And a slower sense in Germany, too. That idea
that
we saw the ZEW survey that came out earlier that shows suddenly people are much more concerned with an actual negative read on this key gauge How much are we looking at that really being a China story, a recovery that wasn't as strong as people thought, filtering into the strength that everybody thought was just shockingly surprising that now seems to be fading on the margins?
It's not just that, is it? It's factory orders in the last few weeks. Go back to the numbers we had from Maersk, big shipping company, saying things weren't great. Mislav Matejka at JP Morgan over the last few weeks has been asking the question, when is it time to drop that overweight Europe story? The time is now, according to them, in the past week or so. The activity upswing seen around the turn of the year, which was helped by the falling gas prices in Europe, by China reopening. Tom, unlikely to transition into an acceleration into the second half. Now, the problem a lot of people are going to have with this tape, if we've been talking about this now for 6 to 9 months, the weakness is here, and we keep pushing out these calls on the weakness.
But then there's a Home Depot just as one proxy.
Sure, I'm with you.
Now it's finally here. And, you know, again, I really want to emphasize sell side saying this call at 9 a.m. hour in Home Depot will be important for the street. I don't know. I'm going to begin with the VIX because Dean Kerner told me to, John. The VIX 17.49. He could care less until we get the gloom of a 20 VIX.
We'll get to Dean in just a moment. Your equity market calm as well, down by 0.13% on the S&P. Tom, yields down just a basis point on a 10-year, 348.69.
Dean Kerner joins us now. Macro Risk Advisors, his first appearance since the pandemic began 10 years ago. We're thrilled he could join us right now. And Dean, with all sorts of accolades and derivatives work, particularly out of University of Chicago ages ago, you go right to the dynamics of variance where there's a microeconomics to it, a supply and demand, and you say, you equate it to after Brexit, where there was a supply strike on volatility. Take that complexity and translate it into where we are right now.
Yeah, Tom, you mentioned the word variance, and right now in markets, there's actually very little variance, at least on a day-to-day basis. If you look at 1 month realized volatility in the S&P, it's in the 25th percentile. So we're in this range bound. You mentioned the word collar. We're just chopping within a range, and without large enough swings, it's very difficult to justify a VIX much higher than it is now. The realized volatility is on the order of 12. I like to call that the earnings engine of long volatility. And that engine right now is sputtering, even as on a forward-looking basis, there's so much uncertainty with respect to the debt ceiling. And you mentioned Brexit. As I think back to that period, in the months preceding June 24th of 2016, options on the British pound got incredibly expensive. And the reason they got so expensive was not because British pound volatility was extremely high, it's because there was a dearth of supply. The folks that would typically sell these options, I think, were being tapped on the shoulder by their internal risk police, saying, listen, do not be short volatility on the British pound at any price. And as I think about that as an analog for what might be to come with respect to the debt ceiling, you see a similar setup, at least potentially, where the sell-side trader who's asked to sell downside puts in the S&P is told by his internal risk monitors, don't sell it. And so without that supply, you could see a jump higher in implied volatility in a hurry.
So 2 things. I can't believe it's almost 7 years since Brexit. I can't believe that. Time has gone so quickly. And I can't believe how much people ignored it after about 12 months.
Right.
On the morning, it felt so big. Do you remember? It felt like such a big issue.
Stunning.
Then really quickly, it became a European story, and then just a local one for the next 5, 6, 7 years.
I have the clearest memory of you working an 18-hour day, and I was trying to find a restaurant in Mayfair, and the streets were in shock.
I have a clearest memory of you doing just that too. Dean, the second point, the memories of 2011. Let's go there.
Yeah.
What are the lessons, and what are you advocating for them with clients right now going into what could be a mess and what might not be a mess?
Yeah, there's the old saying, those who don't remember history are doomed to repeat it. So we try to look to the past to learn. We always do that with some sense of there's always some contamination in terms of what we're trying to isolate. And so if you remember back in 2011, there was the Eurozone crisis that was really beginning to flare up at the same time, August, September of 2011. So we have to realize we can't fully disentangle the massive moves in the S&P 500, the spike in the VIX to 45, because there was the Eurozone flare-up at the same time. There was a big growth shortfall in the U.S. at the same time. However, we should look at it anyway. And, you know, I was coming here this morning, and I just decided to go on YouTube, and I said, Tim Geithner, 2011 debt ceiling. And so I watched Tim Geithner come on camera and talk about the impending disaster, the U.S. doesn't default. And I just said to myself, this is the exact same phrasing that we are seeing now. It's just a different person. Chuck Schumer was actually standing behind Tim Geithner. He's still there, right? So we've got a different cast of characters.
Chuck Schumer was standing behind Eisenhower in 1953.
Right. It's just the same message. And I think what's dangerous, and it's been said before, is that it's going to take some flare up in market prices to motivate this negotiation. And with the VIX of 17.5, you're just not seeing that flare up. We haven't gotten to the point where people are getting actually nervous, and each side is sort of motivated to be the aggressor in terms of trying to get a better deal on this thing.
So we've got the obvious places to spot tension, the at-risk, so-called at-risk maturities. Where would you expect to see it beyond that and perhaps imminently?
Yeah, I love gold. I think gold is a really interesting asset. Again, going back to 2011, you saw gold absolutely spike on both a spot basis. There's a gold VIX. There's kind of a VIX for everything. And so the gold VIX went from 17 to 40 during that period. I think there's a real good case to be made for gold because it's got this concept of limited supply. I think from a Pavlovian standpoint, people are going to look to that to position in terms of just expressing a view that this is pretty dysfunctional stuff from the U.S.
Is there a sense that the CBOE benchmark VIX index is pretty much dead as an indicator of true volatility implied?
I don't think so. I think it's a calculation engine. It became very muted last year. So S&P goes up, VIX only goes down a little bit. S&P goes down a lot, VIX only goes up a little bit. So I think that's why people would characterize it that way. It's just taking in market prices. It's actually started to normalize in terms of its relationship to the S&P or its inverse relationship. It's been more reactive. Actually, right at the failure of SVB on March 9th, the VIX beta to the S&P, or its negative beta, started to rise to a level that's consistent with history. 2022 was a bit of an anomaly for a number of reasons, but it is actually starting to be more reactive. And if you look at June open interest in VIX options, it's extraordinarily high. So people are very positioned via VIX options for some flare up through the debt ceiling.
Just real quick here, we were talking about positioning with people hiding in cash, hiding in gold, being conservative. Even though there kind of is this bifurcated risk. Is this supportive of valuations? Is this actually showing the risk to an upside, to a lack of some sort of catastrophic outcome as being more potentially painful for markets?
I mean, I think my own career in markets has just led me to the conclusion that markets are never say never. You just really can't know what's going to happen. I think about how do you stay long through this, because they probably will figure it out, right? That there hasn't been a default yet. And so maybe markets get a big upswing. And so what do you try to do? You try to stay long in an efficient way. There's opportunities to use instruments like upside calls. Out-of-the-money calls in the S&P have cheapened remarkably since the beginning of the year. On a premium basis, they're down 70% from the end of last year to now. I think that's a great placeholder to stay long risk and to be able to walk away. I like to say the renter, which is what you do through options. You're renting the market. You don't pay for the plumbing problem. And so there's a potential plumbing problem for the United States of America, at least fiscally. And so the option allows you to pay the premium. And if things do go awry, you walk away. I think that premium is actually quite cheap right now.
I will never forget, Dean, what you said in the middle of 2021 when you said that transitory was the new subprime is contained. And I remember hearing that at the time and thinking, wow, that's pretty powerful. And
it was right.
It was dead on. Hey, Dean, thank you, sir. Thank you very much. Dean Kerner there at Macro Risk Advisors. Just distracted by this message I just received from someone listening. Best thing I ever did was ignore the Brexit debate back then. What a waste of time.
Well, yeah.
Thank you for your coverage.
Just for the record, that's a US-based listener, TK, on the Brexit debate of the last 7 years.
I think we'll know in 5-10 years or whatever, but, people that I listen to of all persuasions in the United Kingdom say there's some export-import dynamics here that have changed. I mean, that's all there is to it.
Yeah, and perhaps some labour supply dynamics as well that we need to discuss in our future, too. 8:30 a.m. Eastern Time, 20 minutes away. Tiffany Wilding at PIMCO on US retail sales. Looking forward to that conversation. Going into it, equities just a bit softer, negative 0.2% on the S&P. Home Depot trying to recover, down almost 3% in early trading following a cut to its outlook. More retail earnings still to come through the week.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden meets with House Speaker Kevin McCarthy and other congressional leaders again today to try to avert a default. McCarthy says the two sides are nowhere near a deal to raise the debt limit. The standoff has been roiling markets as investors bet whether an agreement can be reached. There's a sign that economic uncertainty is now leading to a pullback in home improvement spending. Home Depot cut its outlook for the first year after first quarter sales dropped more than expected. Comparable sales were down 4.5% the first 3 months. The company says earnings could fall as much as 13% this year. Airline reservations are pointing to strong demand this summer. According to the International Airport Transportation Association, bookings for the May to September period are 35% higher than a year ago. Asia Pacific experienced the largest jump with a 135% increase. Ukraine says its air defense system defeated what it called an exceptional Russian missile blitz overnight. The attacks included 6 hypersonic missiles that were aimed at the capital city, Kyiv. Ukraine says it destroyed 18 Russian missiles. It's another sign that former Vice President Mike Pence is preparing to run for the Republican nomination for president. Pence's allies have formed a political action committee to support him. Pence said he'll announce before late June whether he will challenge his former boss, Donald Trump. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg has the Fed coverage you're looking for. Today, an exclusive interview with Richmond Fed President Thomas Barkin.
Everybody's got a recession playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound.
Then Bloomberg's Michael McKee speaks with Chicago Fed President Austin Goolsbee.
We should gather further data, and we should be extra careful about raising rates too aggressively.
The most in-depth coverage and analysis of the Fed, right here on Bloomberg, your global business authority.
Chinese recovery has been faster and stronger than expected. Indian demand is also very robust, and we're seeing very strong growth also in the Middle East. And this is contrasting with the sort of the economic gloom and the concerns that we're seeing for the world economy, from industrial activity, and especially in the OECD, where demand has been relatively weak
It's really difficult to reconcile those comments from Toro Bossoni there, the IEA head of oil, with what we saw in the data overnight from China, which looked much weaker than expected, and they're talking about oil demand specifically being better than expected. We'll come back to that in a moment. Crude at the moment, looking at crude this morning on both WTI and on Brent, on the international contract on Brent crude, we had back to 75.35 on the day, just about positive. Likewise on WTI, $71 a barrel. The latest on the SPR, Tom. You seen this? Jen Jacobs, Bloomberg, leading the reporting.
This is like the debt ceiling.
Here's the quote. The US is preparing to buy up to 3 million barrels of sour crude oil to begin refilling its depleted strategic petroleum reserve, according to people familiar with the matter. Of course, they sold 200 million barrels from the emergency stockpile last year. So like 3 million as a start, but it's kind of,
Can I ask a dumb question? Does, like, you know, to pick on the United Kingdom, but does Germany have a strategic petroleum reserve?
That's picking on Germany, but I don't know.
I don't know.
I don't know the answer to that.
I'm just baffled by...
I'm sure our next guest does.
Yeah, well, I'm going to give the guest, but I want to mention on China's slowdown, what really intrigued me was one line item was the property. In China, property really matters, and it really came in light. It was minus 5.8% down to minus 6.2%. And it's just one statistic. It's one little, you know, tea leaf there, but there it is.
Youth unemployment, too, I think, got people's attention. I'm not sure how much of an accurate read you can get on that in the world's second largest economy, but
I agree.
But it got people's attention overnight.
He has been with us not nearly enough recently. Will Kennedy drives all of our hydrocarbon work. He's senior executive editor for Energy and Commodities, and it is wonderful to catch up with Mr. Kennedy at Queen Victoria Street. Will, I'm going to cut to the chase. The Bloomberg Commodity Index is not pretty. We had a pandemic boom, up we went, and we have rolled over. Can we establish a bear market in commodities in general?
Well, it seems like we're pretty close, Tom, and I think the reason is the one that you've alluded to, is that a lot of the data from China is very weak, and what we're seeing is clearly a Chinese industrial economy which is not demanding commodities like people expected it to. When you look at things like the price of base metals, when you look at things like the price of iron ore in particular, that demand isn't there, and the industrial recovery seems pretty weak, and that's partly because they're not building property, like you mentioned a moment ago. But it does seem to be a slightly different picture in oil demand, and that does appear to be a slightly hard thing to reconcile.
Folks, on radio and television, Will Kennedy has the most romantic job at Bloomberg, jetting around the world, running our hydrocarbon team. The romance of it is you're in Singapore, Will, exhausted. Tell us about the Singapore dynamic right now. Obviously, oil through the Strait there and up the Pacific Rim, but far more, all of the back and forth between Australia and China. What's happening in Southeast Asia?
Well, I mean, there is a lot of oil heading through the Straits of Singapore, the Straits of Malacca, that trade in oil all the way from Russia, around Africa, across the Indian Ocean, up into Asia. It's happening, and China and India are buying a huge amount of oil, as the IEA said, and they're upping their forecast for oil demand. And I think what that tells you is another story about perhaps about the two-speed Chinese economy, that the industrial economy is really struggling, but clearly you've got hundreds of millions of people who are flying again, driving again, and that has clearly boosted demand. There's been some weakness in diesel, again, the industrial aspect, but when we look at gasoline and jet fuel, that demand has been there, and there does seem a little bit of a mismatch between the demand figures the IEA is saying that they expect oil demand to reach a record all-time high of 102 million barrels this year, and what people are pricing. We've had this very weak market for the rest of the year. So what you're seeing on the ground in Asia isn't quite at the moment gelling with what we're seeing in financially traded oil contracts.
How do you explain this, Will? Because we've heard this consistently for a couple months now, that basically oil markets are not trading in tandem with fundamentals that really suggest a much tighter market.
I mean, I think it must come down to a couple of things. One, people are trading the future here. It reflects people's anxiety about how the global economy develops from here in the second half of the year. It also reflects supply. I mean, we're all very focused on demand all the time, but I think it's well worth telling people, saying that supply is running ahead of what people expected, and particularly out of Russia. Our weekly tracking of Russian exports saw it as high as it's been in some time, 10% higher than a couple of months ago, and that's not what people expected to see, because Russia had pledged to cut back production. It claims it's doing it, but we're not seeing that in export numbers. There's oil coming out of Iran. There's oil coming out of Venezuela, and I think that there's plenty of oil around meeting an uncertain demand picture. So for all the focus on demand, let's talk about supply. So if you put those two things together, that's one reason why the things have been displayed. And then there's the sort of, I think the way that people have traded oil, which is to use it as an inflation hedge up, and now that people are less worried about inflation, they may be getting out of that trade.
Well, I do wonder, to the point that John and Tom were talking about, the fact that the U.S. may be refilling the Strategic Petroleum Reserve as soon as August, not refilling it exactly, perhaps putting a drop in the bucket with respect to how much they plan to buy. But how much is that potentially going to influence the market, given how much people thought that it did on the other way when they were buying, suppressing prices?
Look, I think it's important that the U.S. has taken that step. I think people are waiting to see that it happened. And yes, it's only 3 million barrels. It's not a huge amount, but it's definitely something people have been looking to happen. And there's been talk about then from administration's officials doing more later this year, early next year. It's going to take a long time, and I don't think they're going to rush or feel the need to refill everything they've sold. I think they're going to take a view on how big it is. But I think it's important, and it's definitely something that traders are going to factor into their thinking when they think about the downside for oil and how low it could go, because clearly you've got a buyer willing to come into the market when oil gets cheap.
Well, very quickly here, is it beneficial for you and the team to watch the dynamics of iron ore right now? Do you glean a lot of information from that?
I think the iron ore market is probably telling us something important about the state of the Chinese economy. And as the Chinese data on the industrial side comes in pretty weak, and it does seem to be coming in weak, I think you would say that the iron ore market has been telling you that for some time, because it's been on a downward move for a number of months, and clearly it is sending a signal about how busy steel mills are in China and the demand for steel from sectors like construction.
Brent crude, 75, WTI, 71. Will Kennedy, thank you, sir, of Bloomberg on the latest effort around crude, what's happening with Chinese data, and what we're hearing from the IEA as well. What you hear on Bloomberg TV in about 35 minutes from now, coming up on the Open on Bloomberg. Mohammed Al-Arian in studio of Bloomberg Opinion.
With us.
Looking forward to that. Cassie Barrow of JP Morgan, Gershon Diston fan of Alliance Bernstein, Tony Dwyer of Canaccord Genuity. It's quite a lineup this morning, isn't it? It's great.
Yeah, it's good.
Some all-stars.
Tony's fired up.
Tony is fired up.
Al-Arian, I got to give you credit, John. I wish we had relegation in American sports. Right now is a prime season where these three teams down at the bottom of English football are going, oops. And I love this story. Folks, this is what it's about. He's 21 years old. He's from Nigeria and Ireland. And Mr. Bazunu, a cup of coffee ago, somebody paid $420,000 whatever for him. And 3 years later, it was $12 million. I mean, the kid was like 16 at $400,000, and then he was $12 million to, I think, Southampton at some time. And now the Tots are looking at him.
So Spurs want this keeper.
Yeah, I guess so, but this is only happening because of relegation, right?
Because Southampton have been relegated to
the league below.
The league below, and what happens is you have to sell some of your crown jewels because you can't afford them anymore, and you've got to try and retain a core of a team to try and get promoted again, and it's very difficult to get promoted. It's really, really difficult.
I just love this, and I think it's, it's like the changes in rules in baseball. These are revolutionary things, and this kid, Bazunu, I just think it's just a perfect example of what could happen.
You know what? I thought what Ryan Reynolds did with Wrexham, it was just awesome, just fantastic. If you haven't watched that.
They went up a league this year?
Yeah, they have. They got promoted, and we'll see if they can do the same again. Just awesome.
Did I do okay there in my soccer talk?
That was great. Well done, TK. Okay. Wonderful. Future's a bit softer.
Hour of study.
Retail sales coming up next.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Signposts on the way to retail sales. Bloomberg surveillance, Lisa Bramwitz and Tom Keene. John Farrell preparing for the next hour. Futures at -7. The 2-year yield 4.01% as well. The 10-year yield 3.49%. That ought to about do it for the pulse of America as we look at productivity and critically the many series of retail sales. That can mean only one thing. Michael.
The control group, which is what feeds into GDP, up 0.7%. The forecast was for a rise of 0.4, and it had contracted 0.3 the month before. Same story with auto, with the overall headline number up 0.4, 1% last time, so not quite as strong there. But the ex-transportation is up 0.4. That was a negative 0.8 last time. So it does look like the consumer is hanging in there, which is what the Fed was kind of hoping to see. If you're going to do the soft landing scenario, you need the consumer to hang in there, and so far they are. I'll let you give us the market reaction. I'll see what I can find out here about what went up and what went down.
And Lisa, the market reaction is higher yields, and I would suggest it's pretty dramatic over the last 2, 3, 4 days. The set of data has got us out on the 2-year thermometer to 4.04%. So there's a tangible lift here in yields, higher yields, bill note bond prices lower as well. And again, equities, like Dean Kernan said, somnolent. That would be the fancy word for it.
Well, I'm looking right now, a little bit better than expected, but still on a real basis negative. And I think this is really the key question.
Key. Thank you.
That the general trend is lower. So even though better than expected, still on a non-inflation adjusted level, an actual headline retail sales advance month over month is 0.4% versus the expectation of 0.8%. The control group better than that, 0.7%, but still, again, on a real basis, still negative.
And this needs some adjustment. As Michael McKee looks at 85 lines that come out within this report, he'll have that all broken down. Michael McKee, inflation is really a significant dynamic here, isn't it?
Yes, it has been, Tom, and that's one of the reasons we're looking also at the control group, aside from the fact that some of these things are accounted for differently in GDP, but it also takes out gasoline, and gasoline's been a big mover for the retail sales number over the past couple of months because it's been going up and down. It's one reason that we saw a decline last month, and it's a reason that we saw a rise this month in retail sales because gasoline station sales fell on the month by 4%, it looks like. That makes a big difference out there. The other categories that moved significantly, though, were general merchandise stores. And I think what you have here is between the April and May numbers, or April and March numbers rather, is Easter effect. Easter was early in April this year, so some of the spending that would have taken place in March moves over to April, and you want to average that out. But overall, I think the bottom line that Lisa brought up about inflation still playing a role is there, but you also have to look at the fact that consumers are still spending, and we aren't seeing necessarily any signs of recession in the retail sales figures.
Mike, you're going to get in your 36 holes on Amelia Island here, helping out the Atlanta Fed, and you're also going to be in conversation with the McKinseyite Barkin, and also the academic from Chicago, Goolsbee. These are two important, different conversations. Let's focus on Austin Goolsbee, who's someone reticent to raise rates higher. Do I have that right?
That is correct. He's more worried about the fact that the Fed has done so much that it wouldn't take much to tip the economy into recession. So he's been saying he thinks maybe a pause is a good idea. Stop and look around and see what's going on. We'll be asking him what would change his mind on that, because we do have a couple of inflation reports before the next Fed meeting.
Mike McKee, thank you so much. Really appreciate that this morning. It's really important here, I think, to look at the retail data, rip it apart. And someone that can do that, of course, is the gentlelady from PIMCO, Lisa.
And this really is the question, especially after we were talking about a discretionary recession. Are we seeing that in the data? Joining us is someone who focuses on this all day, every day. Tiffany Wilding, economist at PIMCO, 5:30 a.m. their local time. Thank you for waking up and keeping Eastern time so that you can partake. But I'm curious, Tiffany, from your vantage point, are you seeing signs of some sort of discretionary recession, or is that premature?
Yeah, well, I mean, I do think that the consumer, some of the momentum in consumption has decelerated since the beginning of the year. So, you know, the first quarter was extremely strong in terms of consumption growth, over 3%. You know, but a lot of that, as we know, if we look at the sequential monthly data, it was really boosted by warm weather in January. And then we saw a deceleration in March, and it looks like we're getting a little bit of a pop back. But as Michael suggested, there's probably some noise around Mother's Day here. So you kind of have to smooth that over. You know, so we would suggest you are seeing some decline or growth deceleration in consumption. But overall, you know, as was said, the consumers are hanging in there. You know, and of course that's also going to be a function of the labor market. You know, and it is still reasonably strong.
Hanging in there and willing to pay the prices that are being demanded are two different things. Is there a sense that there really is starting to be some pushback to the inflation that's being borne out in consumers' pocketbooks and in the fattening margins of profits at companies?
Yeah, well, so, I mean, we're definitely starting to hear more of that coming from, you know, the various earnings releases from some of the consumer companies. You know, they're saying, obviously, that consumers are a little bit more price sensitive in various categories. I would say when I look at the macro data, you know, I don't see it as much. And of course, we need more macro data. You know, if we're starting to see these trends at the company level, they're noticing it, you know, then it'll come out with the macro data with a lag. You know, but overall, I would say inflation is actually still, you know, still reasonably robust. I mean, obviously at 5% or more, it's over the Fed's target. You know, we do expect it to come down, but I think continues to be stickier than expected.
Tiffany, I need to ask you this because in the equity market, I've been looking at the slow motion convergence of moving averages down to what Lisa and I call a snooze fest. I got the same thing in the bond market. If I look at the 2-year yield, there's a teensy-weensy 2 basis point differential in the 3 moving averages I use. Does Jerome Powell call that a success? To see the lethargy, the boredom within the bond market described by the 2-year yield?
Well, you know, I do think that the bond market does listen to the Fed. You know, I think sometimes commentators like to look at, you know, just the forward curve, which does suggest, you know, a significant probability that rates will be lower by the end of the year, to suggest that, you know, the markets aren't listening to the Fed. I do think the markets are listening to the Fed, but I just think the markets probably have, you know, in terms of their distribution of risks, they assign more downside risk to the economic outlook than the Federal Reserve does. If you take a historical look at banking sector crises and stresses defined by 30% drops on average in banking shares, you do tend to see the economy decelerating after that. And that'll of course come from tighter credit conditions for consumers and households.
What do you hear from then your PIMCO portfolio managers without giving away the crown jewels? What does PIMCO say about the dynamics in this banking crisis in agency paper?
Yeah, well, of course, there's some, banks that failed, obviously held, they held a lot of treasuries as well as agencies. Obviously that will need to be sold. We think that's probably priced into the market, though. There's a pretty good understanding of exactly what that is, in terms of how much it is. And obviously the Federal Reserve is also shrinking its portfolio, but on the other side of that, you don't have a refinancing wave because interest rates are so high. So overall, we think it's priced in. We actually like agency MBS. We think that they actually provide pretty good value right now, just because volatility has been high and the level of interest rates are high, and those things can mean revert back down.
As we prepare for a slew of retail earnings, particularly tomorrow with respect to Target and then Walmart, do we get a sense that perhaps people are too bearish, that Home Depot was an outlier, and that otherwise, to your point, the consumers are still spending and they can keep borrowing to do so?
Well, so the data that we got, some credit data from the Federal Reserve, which did look like there was some reduction in credit card, or there was a deterioration in credit card loans and things like that in the first quarter. So I do think there are consumers out there that are feeling pain, and I do think banks are tightening credit conditions. The other piece of this, obviously, is just demand for credit, and demand for credit is also falling just because rates are so high. You obviously, it's more expensive to take out loans, et cetera. So, all of this to me is suggestive that, monetary policy is working. The consumer, ultimately they are getting squeezed, some of the lower income consumers more so than others, and you are seeing some deceleration in credit growth as a result of the current environment.
So as you put this all together, is inflation decelerating enough to really get the Fed where they want, or are we looking at a sort of higher inflation but also higher growth kind of area for a longer period of time?
Yeah, I think that's yet to be seen. As I mentioned, we do think this banking sector stress is going to impact the economy. It's going to slow things down. Higher interest rates take time to work their way through the economy with a lag. And I would even say inflation even lags, activity momentum. So growth. So, I think we're seeing these lags start to play out. You have seen inflation decelerate. It's probably going to continue to decelerate given the monetary policy restriction that's in place. And the Federal Reserve, just needs to be patient, as does markets, just needs to be patient to see that. So we think inflation does decelerate to 3% core CPI, for example, by year end, 3 to 3.5. But obviously that's still above target. There's still some sticky trends in inflation, but ultimately the Fed probably will be successful in getting it back. The question is, how big of a recession do they need to do that, I think.
Thank you. Tiffany Wild, greatly appreciate it with PIMCO. Right now we're going to drop into the Bramo world. We can do that right now. And I just did this really quickly, Lisa. I'm an amateur compared to you. I brought up Apple Computer, and I went out 10 years, like a 10-year benchmark, the 4.3% coupon, and I'm picking up 76 basis points, 75.9 basis points over the Treasury. That's the real world of all of our guests, is they're trying to make that teens-weens amount over Treasuries. You do that with Apple.
And a lot of those big-name blue-chip companies are selling debt right now because they're not having to pay that much of an extra margin over treasuries because people are saying, oh, you guys are going to be just fine.
I can't emphasize enough, folks, how the world has changed. There's a coupon out there. All of a sudden, total return and coupons matter. Very different. Futures at -11. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House and congressional leaders head into another session of debt limit talks today to try and avoid a default. President Biden has said he was optimistic a deal could be reached, while White House Speaker Kevin McCarthy expressed that ongoing discussions were not productive at all, and leaders are nowhere near reaching an agreement. Bloomberg's learned that Saudi Arabia is moving closer to another stock offering in Aramco, the oil giant. Any deal would be one of the world's largest share sales in years. Proceeds from the sale would be transferred to the Saudi Sovereign Wealth Fund. The former CEO of Silicon Valley Bank says the Fed and social media contributed to the lender's collapse. Greg Becker testifies before the Senate Banking Committee today. He's expected to blame the fastest pace of hikes by the Fed in decades. According to prepared remarks, Becker also will point a finger at negative social media sentiment. A special counsel faulted the FBI and Justice Department's probe into whether Donald Trump's campaign conspired with Russia in the 2016 election. Still, John Durham failed to issue any new charges or recommend significant changes to investigative procedures. The former president had claimed that Durham would reveal a conspiracy to undercut his presidency. A group of senior officials from Tesla are visiting India this week, looking to expand its supply chain beyond China. The visit could represent a thaw in the relationship. Tesla CEO Elon Musk has criticized India's high import taxes and its electric vehicle policies. India has advised Tesla not to sell cars in the country that have been made in China, its political adversary. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep rate World Cup.
This is a 3. As the economic picture does.
The BOK is getting ready to make
It's very clear that the consumer is on fragile footing, but they're proving resilient, at least temporarily. Consumers are increasingly willing and accepting of that level of inflation, but going forward, it's all going to come down to that stockpile of wealth and the ability for the consumer to make purchases in the marketplace. At some point, those savings, that wealth runs out, and businesses won't be able to pass on that cost increase without a significant loss of market share.
Very valuable yesterday. Lindsay Pieggs are with us, the Stifel chief economist there on the state of the American economy. Lisa, she was talking about Atlanta GDP now with a run rate of 2-ish%, and you wonder off retail sales today where that will end up, where that will settle.
Again, resilience, which has been sort of the conundrum that a lot of people have been dealing with. If you've got resilience and growth, does that also mean resilience of inflation, which creates a real conundrum for the Federal Reserve?
Off retail sales productivity yields higher, 4.02% on the 5-year, 10-year yield 3.52%. Equities have vacillated today. I'm going to call it on an SPX of -9. maybe not as gloomy as the shock of Home Depot and the same-store sales miss there, Lisa, but there's a little weight to the tape today.
There's a nudginess, as you would say.
I like that,
How
yeah.
much is this really Kevin McCarthy coming out and saying that there's no deal? So that tail risk isn't off. You then have China in the situation where you get data overnight that shows that growth really isn't so even.
Right.
It's kind of sputtering, and it's not going to persist without some sort of government support.
I think you're dead on China. I do think it moved the markets today, and we're going to get a brief on that right now. We've been remiss not to do that through a busy morning. And Curran joins us in Washington, of course, with these years of experience in Hong Kong and living the Chinese escape from COVID. He is our global economics correspondent. And I looked at the nuance of a property market worser. What was worser for you in the report of China?
Disappointment across the board, Tom. Look at youth unemployment, up towards 20.4%, another record level. 12 odd million graduates coming onto the marketplace in China this year. That's going to be a real concern for China's recovery. Of course, then you had retail sales missing forecasts, industrial production missing forecasts. And by the way, they were being compared against a weak base from a year ago as well. So really soft numbers for China across the board. And you'd have to say probably disappointing. Remember a few months ago, we were all talking about, wow, China's reopening now. Let's see where these rocket boosters go in terms of consumption and industrial production. How does it spill over? How will it impact global inflation and everything else? All legitimate questions at the time. But here we are now in May, and it's looking like something of a fizzer, so to speak.
Well, unless there is some sort of investment by the government, unless there is some sort of support or stimulus, how much discussion is there about the PBOC, about the Chinese Communist Party coming out and injecting more cash into the economy?
There is always discussion around more public support for the economy, Lisa, for sure. I think one of the critical takeaways, though, will be what's happening with youth unemployment in particular. We know, of course, how job creation is the modus operandi of the government there. We've had some comments from the official sector, or colleagues in Beijing were reporting on, making the point that they will be taking steps to ensure jobs are created. Some economists are making the point that the recovery kind of favoured low-end services workers rather than, say, more educated workers up the value chain. Those are the ones that are losing out this time around. That certainly won't be an easy story to fix, given the broader, difficulties that China's technology sector is facing, given the U.S. tensions. So I think there might be more support coming, but an interest rate cut isn't going to turn this around. Clearly, youth unemployment needs to be addressed, and obviously broader government spending will be needed to pick up the investment side of things.
So if anyone was waking up today and hoping that we'd get some clarity on the soup of data and storylines that we've been getting over the past 6 months, you're wrong. You're not going to get it, because we've not only got this data out of China that shows some sort of, I don't want to say slowdown, but a choppy recovery. You get the IEA coming out and saying, actually, Chinese oil demand is increasing dramatically and is going to really support oil pricing. So how do you square this circle?
Well, this was meant to be this was the talking point of the year. China comes back online. They are the world's biggest purchaser of oil. Chinese travel, both consumer and business level, would have an impact on global oil prices. But obviously, it's there. It's offering some support in that market. Analysts talk about it every day of the week. But we can't say, I think, China's offering a major fresh impulse to the global inflation story, at least not yet, Lisa.
And I want to go to your wheelhouse coverage in Hong Kong of the fears that the West has through Hong Kong over all of China. This president begins a three-nation Indo-Pacific tour. It is Japan. Amory Horton will be there, folks. Papua New Guinea, and then I believe down to Australia. An exhausting trip. There's no ifs or buts about it. And one of the major goals here is to contain technology placement in and out of China with our allies. Can we do that? Can we actually control the technology movement of our allies into a nation that we fear?
Well, there's no doubt that the U.S. export controls and restrictions on investment have certainly been hampering parts of China's economy, in particular the semiconductor sector. Some companies especially caught in those crosshairs, for example, like Huawei was one example, and some U.S. allies have been on board for that story as well. But you'd have to say at the same time, we've been reporting, and others are reporting, that there's also signs of resilience in China's high-tech sector, in the semiconductor sector, among some of those individual companies that have been impacted, like Huawei. So the question of about whether or not the U.S. can kneecap China's high-tech development, I think, remains an open one, but clearly more measures are expected still to come from the White House.
The distinction this morning seems to be a recovering China versus an industrial China. Do you buy that? Is that the dichotomy we should be looking at?
Well, I think, the biggest surprise has been the sort of slow rebound of consumers. The Western story was pent-up demand after they moved past the brunt of the COVID restrictions. That hasn't really played out in China. Maybe it's because it was a different dynamic. The COVID zero meant there was no COVID there for a couple of years and people were out and about as they normally would. So perhaps we should never have expected that kind of V-shaped rebound to begin with. But nonetheless, I think the slow recovery and the fragile confidence of the Chinese consumer doesn't bode well for China's economic recovery, and certainly doesn't bode well as spilling over for the rest of the world in terms of global. I think China's slowdown, coupled with the noise coming out of Germany's industrial production side of things, it all points to, I think, slowing momentum as we head into the second half of this year.
As you're speaking, we're getting some headlines from Cleveland Fed President Loretta Mester in some prepared remarks as she speaks at an event in Dublin, Ireland. She's talking about how data shows us that rates are not at a sufficiently restrictive level. She talks about how monetary policy must consider long-run economic trends and that they are committed to returning inflation to 2%, but not yet at a level to hold given the stubborn inflation, given the fact that we have heard something of a break in views on the Federal Reserve. And from an economics perspective, is that the case, that it's not necessarily clear whether monetary policy is at a sufficiently restrictive level?
Well, again, this is the big question. I mean, the U.S. has certainly got a lot of balls in the air right now, Lisa, when you consider what's going on with the banking shock and how that may or may not impact lending as we go forward in the months ahead, especially for the smaller business community. We've had 5-odd percentage points of interest rate increases here in just over a year. There are plenty of economists who say, look, textbooks say that's going to come down the tracks at some point sooner or later and hit consumers and households and businesses. And then, of course, we have the debt ceiling debate. There is a sanguine view that will all be navigated. Markets aren't really panicking yet, but nonetheless, it's certainly a pretty serious debate to be having for any government. And now to your point, some Fed officials are saying interest rates still aren't where they need to be. They need to go higher. Well, of course, there are plenty of people warning that the Fed has already gone far enough, that they're only storing up trouble for down the road. It's a very academic question as to where you do actually hit restrictive territory, where the new neutral rate is, so to speak, as well, Lisa. But either way, I think it's a big call for the Fed now in terms of how they balance this going forward.
And Curran, thank you so much. In Washington this morning, futures -11, a little weight to the tape here is well, there's Fed speakers, and then there's Loretta Mester. I'm sorry, I'm going to treat her differently. They're all different. Barkin with Mike McKee, Goolsbee with Mike McKee, two very different individuals. And then there's the mathematician Mester, who has a concision the other two don't.
It really flies in the face of market expectations that the Fed has done. The pause is about to happen, and then they're going to keep on going. It also shows she's not ready to pause. We heard something different from Raphael Bostic, who is saying, all things being equal right now, to Michael McKee in his conversation yesterday, he is ready to pause. So again, this real difference, do we see that in dissents coming out in the Fed?
I think we'll see it in the data. They're all, the common ground of Austin Goolsbee and Jim Bullard is they're data dependent.
Which data? They're all looking at different data.
They're looking at different data, but far more importantly, on an ex post basis, they got to get out and after the fact, get in the data, and by definition, be after the fact. And to get out here, he's going to close the show. I can go to FOMC Go, so can Lisa. June 14th, July 26th. Where are we going to be November 1? I got a clue.
Where are we going to be
I have
June
no
14th?
Clue. Yeah. June 14th. Maybe we'll get to Memorial Day weekend. Michael McKee with Barkin and Goolsbee from Amelia Island. Stay with us. This is Bloomberg.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Tons of Fed speak and a little bit of economic data. What more do you want? Live from New York City this morning. Good morning, good morning. Just a little bit softer on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, views beginning to splinter at the Federal Reserve, some cracks beginning to show at retailers, and Yellen doubling down on an early June ex-date. We begin with the big issue, challenging the resilience of the U.S. consumer.
Consumers are proving resilient.
The consumer looks strong. Still strong.
Consumers are still spending. They are able to tap into some stored wealth.
Consumers okay, but it's the consumer's behavior that we're worried about.
I mean, you've got growth problems that are starting to emerge.
A lot of cracks surfacing, signs of worry.
The rise in credit card rates and the rise in revolving lines of credit.
The consumer is on fragile footing.
They are waiting for the other shoe to drop.
In the second half of this year is when things start to unfold.
Maybe later this year rather than earlier.
We will be watching the earnings closely.
This week could be very important.
I'm pleased to say that joining us now to discuss is Mohammed Al-Aaron of Queen's College, Cambridge. Mohammed, good morning to you.
Good morning. Thanks for having me, John.
We have found the pain point for regional banks. Have we found the pain point for rates for this economy?
Not yet. There is so much confusion out there that people are not even sure where the rate point is. What we do know is that the consumer is holding on better than most people expect, and the global economy around us is weakening. That's what we know. What we don't know is what is the right level for interest rates, and I would go one step further. What is the right inflation rate for this economy?
We're going to pick up on that point a little bit later on this morning, because I know you've got a lot of thoughts on that. The Fed speak of the week so far, there's tons of it. Concludes with Chairman Powell later on this week on Friday. Goolsbee suggests maybe we're done here. He was close to being done at the May meeting. Kashkari is talking about perhaps being open to more. Where are you right now?
So it is fascinating to me that to see the range of views. As you say, there's one view we should have not increased last time. There's another view we should increase next time. Then there's the collective view of the Fed, which is we will not cut rates, versus the market view that we will cut rates. John, that tells you three things. One is the economic situation is fluid. Two, compositional issues matter. If you look at the service side, you get a completely different set of answers than on the good side. And three, the Fed hasn't anchored expectations. We have no view of what the strategic and secular view of the Fed is. And until we get that, you're going to get more splintering, not less.
Do you believe that the effort to get inflation back towards target is time sensitive? Or do you think you can push out the time horizon to ultimately achieve that goal?
I think ultimately you will push it out because achieving it in a short span of time has too much cost for the well-being of Americans and for the well-being of the global economy. You cannot crush the economy to get to 2% because we are living in a world of deficient aggregate supply. And if you try, it will be counterproductive.
Just to be clear here, this is still your opinion, that to achieve a 2% inflation goal, you would have to hammer the economy. Now, when you say crush the economy, you're talking about unemployment of 5, 6, 7, 8%. What are you talking about here?
I'm also talking about the inability to bounce back quickly. So there's a dynamic here. If you try to run an economy at an inflation rate that is too low, given the amount of resource reallocation that's going on, then you will crush it. Look, we have three issues standing there. We have a major energy transition that we have to navigate. We have the rewiring of the global economy that's happening not just for geopolitical reasons, but also for companies looking for more resilience. And then we have the functioning of the labor market. You put these three things together, if you try to get to 2% quickly, the cost far exceeds the benefits.
Well, you know what the Fed implies right now in its projections, median forecasts right now. Unemployment goes to 4.5%. Rates stay here, implied by the median dot, and inflation is on a glide path back towards 2. How would you characterize those forecasts from the Fed? They get updated in June, by the way, as you know.
I would characterize them the same way I've characterized almost every single forecast we've had for the last few years as hopeful but not realistic. We haven't talked about the third part of the trilemma, financial stability. Right? So there's three elements. And that's what you get when you're late, is your dilemma turns into trilemma. And we have to talk about financial stability as well. So look, unless the Fed comes out and anchors quickly the markets, where in terms of what is its characterization of the medium term, we're going to get more and more differences, not fewer.
We've gone back and forth on the regional banking stress. I've called it a crisis, you've called it something else. We won't debate that here and now, but you've talked about the several phases of it. What phase of that are we in at the moment?
So we are out of the ICU. That was the acute phase. We are still in the hospital because there are problems with the banking model of certain banks. And the key issue now is to allow the patients that are in the hospital to come out. And if there's another policy mistake, the patient goes back into the ICU.
What would a policy mistake look like?
If, for example, we ignore the fact that we can't get to 2% inflation easily and we go after it too quickly, that would put the patient back into the ICU and would bring back a second set of patients that we don't talk about, the non-banks, what's happening in the non-bank financial sector.
What do you think is happening there right now?
So the good news there is it's slow moving. So think of commercial real estate, think of the 1.5 trillion that has to be refunded. That doesn't happen immediately. That's the good news. You don't have the dynamic of deposits. The bad news is that's going to happen over time. So we've got to be really careful to navigate what's coming.
All roads here seem to lead towards this idea, Mohammed, that you think this Fed should be done and should come out and explicitly say it, and that they're done because they think an inflation target of 2% is unachievable. How on earth do you go around communicating that?
That is a problem. This Fed hasn't been known for good communication. It's been known to more confuse markets. We have the study that shows that volatility is 3 times as high during the current press conferences than they were before, that the market ends up feeling one way after it felt the other way after the statement. So communication is an issue, and we need to get that clarified. Having said that, John, it is really important for everybody to know where we're going to. Everybody's data dependent. So it's as if you're driving on a freeway and you just care about the cars around you. There's 2 other things you need to know. What is my destination and is it feasible? You need to know these 2 things. It's not enough to be data dependent.
What does that phrase even mean anymore? That phrase drives me nuts.
It does drive you nuts.
What does it mean anymore?
It means that I don't want to take a strategic view I don't want to put my views out there, so I am going to be completely tactical. However, there's a problem, which is you are tactical with a tool that operates with lags.
The long and variable lags. Governor Jefferson talked about them. How long and how variable are they?
They are not as long as they used to, but they're long enough for you to have a forward view and not just a backward view. And we've got to get out of this excessive data dependency. You should be data dependent, but in the context. The great discovery of Bill Gross at PIMCO was that you should always have a secular and structural underpinning to what you're doing today. Don't just get whipsawed by the markets. Have a view as to where you're going. And the Fed needs to share with us what is that view? What is the characterization of the economy we're functioning in?
Which is why you used to have both a cyclical and a secular outlook, and PIMCO, by the way, still does. Are you suggesting that's what the Fed needs to provide now?
Absolutely. I mean, the only secular view we have comes from the new monetary framework, which is a world of deficient demand. But we live in a world of deficient supply. So we have a framework that is built for the world of yesterday and not built for the world of today or tomorrow.
Mike McKee's been looking at some of these things down in Florida, catching up with Fed speakers and, of course, reacting to the latest economic data as well. Mike McKee, let's start with the data first and then shift to the Fed speak. What did you make of that retail sales print from 36 minutes ago?
Well, it does suggest that the consumer is hanging in there. There's a lot of things you want to do with the data, massaging it in terms of the fact that Easter moved from March to April this year, and so it affects the skew of the data. Also, energy prices coming down. But as you can see, the trend is up. And it does show that consumers are hanging in there, which just makes it a bigger question for the Fed about what that's going to mean. It helps them with the idea of a soft landing, but what we don't know is whether or not it's going to be inflationary. Some of the inflationary categories like gasoline dropped in retail sales this month, but there are still wage pressures out there that Fed officials are worried about. We had Loretta Mester this morning speaking over in Dublin, Ireland, saying that she doesn't think that the conditions yet for a pause have been met.
Mike McKee, thank you, sir. I thought Mike might have some sound there, but he doesn't. Mike McKee, thank you very much. I want to turn to Home Depot numbers just quickly. They came out in the last couple of hours, and the stock is down by about 2.9% in the pre-market. The company coming out in the last couple of hours, Mohammed, and basically communicating to us that they've had to cut the outlook for 2023. Clearly there was some pull through, some pull forward of demand here for this company. The goods sector, we had a guest earlier on this morning on Bloomberg Surveillance, I'm sure you may have heard it, who said that we face a discretionary recession. And the question I was asking is, does that go from goods to services? You've seen that in goods. Do you see the potential for that to bleed to services?
It may bleed, but we are really far away from this. And that's one of the challenges of the Fed, is if it looks at the goods sector, it is relaxed. If it looks at the service sector, it is worried. And we need to spend a lot more time understanding the dynamic of the service sector. Look, John, you have two sets of companies now. The extremes are Home Depot and the airlines on the other side. Home Depot has inflation biting into declining sales. The airlines have pricing power and have massive demand. And what we're going to see increasingly is this dispersion in companies depending on which sector you are serving.
We'll catch up on the retailers through the week, of course. It's not just Home Depot earlier this morning, it's Target tomorrow, Walmart the day after that. Looking at S&P 500 futures right now, around about 20 minutes out from the opening bell, equity futures on the S&P, negative 0.3%. Mohammed's going to be sticking with us. Let's get you some movers. Here's Abby.
Let's stick with Home Depot, John, because it really does stand out with the stock down. Cutting the outlook, the quarter that just was weak. Also, demand weak for sales, which missed. They're now talking about sales comps for the year of down as much as 5%. Previously, they had been looking at flat. They're talking about the discretionary spend not there. Some of the other categories, such as plumbing, that are more necessary, that's strong, but patios and grills, not so much. Turning to one space that's up today, Capital One, we have those shares popping sharply higher as Berkshire Hathaway takes a stake. We also have Nubank higher. They put up a strong quarter. That's another Buffett-backed bank. Horizon Pharma, on the other hand, plunging down 18%. We have the FTC challenging Amgen's $28 billion deal. This would be the biotech giant's largest deal in history. They are basically saying it could hamper innovation and slow the pace of drug development. Not surprisingly, Amgen's higher, but not so much. So it's going to be interesting to see how this story evolves with time, John.
Abby, thank you. We'll touch base with you again in about 20 minutes around the opening bell. Coming up, Speaker McCarthy sounding pessimistic ahead of a second round of debt ceiling talks.
We're only a couple weeks away. You've got to have something done by this weekend. We are nowhere near any of that.
That conversation with Mohammed Al-Erin, JP Morgan's Kelsey Barrow, and AB's Gershon Distenfeld up next.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
The staff is very engaged. I would characterize the engagement as serious, as constructive. The most important thing is making sure that Congress fulfills its basic responsibility to avert default.
National Economic Council Director Lau Brainerd calling staff-level talks both serious and constructive. Here's House Speaker Kevin McCarthy's take on the same thing.
We're only a couple weeks away. But if you look at the timeline to pass something in the House and pass something in the Senate, you've got to have something done by this weekend. We are nowhere near any of that. I appreciate the president signing in to talk after 97 days, but there is no move.
According to him, staff-level meetings are not productive at all, and we are nowhere near reaching a conclusion. Meanwhile, Secretary Yellen is doubling down on her warning in a letter to congressional leadership, writing the following: "We still estimate the Treasury will likely no longer be able to satisfy all of the government's obligations if Congress has not acted to raise or suspend the debt limit by early June, and potentially as early as June 1st. Yellen indicating the U.S. is already paying the price. Joining us now from Capitol Hill is Kayleigh Lyons. Hey, Kayleigh.
Hey, John. Well, there seems to be diverging views clearly on how much progress staff-level talks have made in recent days, but it is going to be the principals in the room today at the White House. President Biden, along with Vice President Kamala Harris, will be meeting with House Speaker McCarthy as well as the other big congressional leaders. So there is a question of whether or not we will emerge from that meeting in the Oval Office today, what we will hear when they all go to the sticks and speak about the progress that they made in the room. What we understand is on the table are ideas like spending caps, though the Biden administration would like that to be in shorter duration than Republicans would like. Permitting reform also on the table, as well as work requirements for entitlements. The thing is, John, that even if these five really can reach a deal today, that is just part one. This still needs to be sold to the rest of Congress and ultimately passed. That is where the timetable gets incredibly difficult because remember, the president is scheduled to depart for Japan tomorrow, and of course the Senate is scheduled to go on recess starting Thursday through the Memorial Day holiday. So the clock is ticking as Treasury Secretary Janet Yellen reminded Congress yesterday. Not only did she reiterate that it could be as early as June 1st that the Treasury is unable to meet all of its obligations, she also warned about cutting it too close to the X date, really hearkening back to the 2011 episode, saying we have seen that pushing it too far near the brink can raise taxpayer borrowing costs, impact confidence, and of course ultimately affect the credit rating of the United States. And she of course pointed to the market action we have already seen and how the Treasury's borrowing costs on maturities, securities maturing in June have moved higher. It's a warning from Yellen, John. The question is whether the negotiators today will be heeding it.
Here we go again. Kaylee, thank you. Joining us now to discuss JP Morgan's Kelsey Barrow, AB's Gershon Distenfeld, alongside us, Mohammed Al-Arian. Kelsey, first of all to you, and fold in this debt ceiling drama down in Washington as well. You and the team seem to believe that the road to recession is already paved. Why?
Well, we see the cumulative and lagged impacts of 500 basis points of rate hiking, the fastest monetary policy tightening since the 1980s. You add on a quantitative tightening, a highly uncertain situation with the debt ceiling, and we see the leading indicators, whether it be NFIB, Conference Board, they all suggest that growth and inflation should be continuing to slow. Now, I know we're hearing a divergence of Fed views right now, and I'm not surprised that they are not admitting victory at this point. They are going to be very hesitant to admit victory, and here's why. They have 500 basis points of policy space. That's way more than they've had in the last multiple decades. So for now, they're going to maintain a hawkish bias, or at least one where they are on pause. But in the background, we do feel that the leading indicators are already pointing towards slower growth and ultimately a recession.
Gershon, let's build on that. Is it time to put on end-of-cycle trades? And what are end-of-cycle trades in the cycle like this one?
That's a very hard thing to gauge, John. You know, the reality is that, we're all obsessing over, did the Fed make the right move, earlier this month by hiking rates? What are they going to do next time? And the real issue is, how long do they stay here? And, we continue to think what they've said, and this is where I disagree a little bit with what something Mohammed opened with, that there's no strategic plan. I think there is a strategic plan. I think they've been clear that they're willing to wait it out. They don't want to repeat the mistake of the 1970s. So they're going to keep rates high for quite a bit of time. Now, why does it appear like they're not clear? It's because, the market mostly cares about what they're going to do next time. Where is the terminal rate going to be? Which is just not as important. So they don't communicate very well on that, but I think they have communicated pretty well that they're going to be higher for longer. They disagree with where the market is. And yes, that probably leads to a higher chance of recession, and portfolios should be positioned that way.
Gershon, in the old days, you never took on the Fed. If it is true that they have been so clear, why is it that the market is not listening? What is the market seeing that the Fed is not seeing?
Well, I think the market may be saying that there's just a much higher probability of something bad happening. If I look at the last 4 times that the 2-year note traded over 100 basis points below Fed funds, we're thinking about 1989, we know what happened there. 1998, we know what happened there, 2000, and 2007. All times where, for different reasons, the markets were about to fall apart. So I think it's a very, very bearish sign. Haven't been a huge believer in just looking at the yield curve, but the fact that it is so inverted is saying that it's likely something bad's going to happen. Now, what is that bad thing? Could it be the debt ceiling debacle? Could it be reignition of bank fears? It could be a severe softening in the labor market. Who knows? But I think that's what the market is pricing in. Maybe consciously, maybe not consciously.
So, Kelsey, you said earlier that you feel that there's something bad will be the high likelihood of a recession. Can you speak to the nature of that recession and whether it triggers the credit risk concerns that then undermine the marketplace and undermine the recovery from that recession?
So what I heard from your question on credit risk specifically, the default rate has been very low so far in this cycle, but we are expecting that it's going to start rising. And so, yes, in a recession, you are going to have higher defaults. You're going to have a higher default rate, and spreads are going to need to widen to compensate for that risk. So as we adjust portfolios, the way that we're positioned is long duration, but also up in quality. So investment grade over high yield, looking at things like agency mortgage-backed securities, where spreads are 150 basis points over the Treasury, and that's for something that's government guaranteed. So, you know, exactly how deep the recession, we're not sure, but when we look at where spreads are currently priced, they're not really priced for any type of recession, whether it be a garden variety of recession or a more severe one.
Gershon, let's speak to that and build on it a little bit more. Can you tell me how you're thinking about the performance of credit, high yield versus, say, equity right now, and within high yield, loans versus, say, bonds?
Sure. I mean, to start with, just I think I differ a little bit with Kelsey in that, you know, spreads are incorporating quite a bit of stress. You can't go apples for apples. You look at spreads, they look kind of average, median, but the quality of the market is so much better. We went through a cleansing period over the past 3 years where you did have a lot of defaults 2 and 3 years ago. So I think the starting point is much better. So again, I wouldn't go crazy. I certainly have an upper in quality bias, but I don't think that we could say that spreads definitively are not compensating you. As you're alluding to, John, I continue to think that the equity market is telling a very, very different story. And in fact, if you believe the equity market is saying that things are going to be pretty sanguine here, I think high yield's pretty cheap. Now, it might go the other way as well. You know, high yield versus loans, I don't really have a strong opinion at this point. I would just point out, and this applies both in the public and private markets, when you're looking at floating rate debt, that's obviously performed very well for investors in this rising rate environment of the past 18 months. But now those companies have increased interest obligations, and one has to look at that very, very carefully. Companies had a choice years ago. You know, a solid double B could have issued at 4.5%, 5% 2 or 3 years ago, and if they did, they have that rate for the next, you know, 5, 6, 7 years.
Yeah.
If instead they chose to take, at the time, the cheaper path, you know, issued it in the loan market at LIBOR plus 325, they had a lower cost of financing for a while, but now their cost is 8% and maybe even going higher. So one has to be very careful looking at an entire capital structure, how much exposure there is, and whether a company really can repay their debts.
Hey, Gershon, great to catch up alongside Kelsey Barrett. Mohammed, I'm pleased to say, is going to stick with us. Up next, the morning calls, and later, Tony Dwyer of Canaccord Genuity.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Let's get you some morning calls. Argos upgrading Royal Caribbean, seeing signs of improving demand and strengthening margins. BMO upgrading Gilead, highlighting the company's strong manufacturing capabilities. And finally, Gordon Haskett upgrading Expedia, saying investors are overlooking solid fundamentals. Up next on this programme, Tony Dwyer of Canaccord Genuity.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Seconds away from the opening bell in New York. Good morning to you. Equity futures going into that open just a little softer, negative by 0.24% on the S&P 500. On the Nasdaq, we're negative here by about 0.25% also. Weaker after retail sales of the control group still look pretty resilient and strong. Home Depot, though, flagging some cracks for the U.S. consumer. There's the opening bell. Switch to the board and get to the bond market. Yields look a little something like this on a 10-year, higher by 4 basis points following that retail sales print, 354.52. Look out Europe. Really interesting story emerging here for the euro. The data's starting to weaken. 108.76. Last week was the worst week for the euro, going back to September 2022. The data this morning, the ZEW, investor confidence in Germany, not that important, but starting to crack just a bit. Worth taking a little bit more attention and placing it on what's happening in Europe at the moment. Crude right now, $71 and about 13 cents. We're virtually unchanged there on crude in the commodity market. Let's get you one stock to watch at the open. Home Depot, been talking about it all morning. The retailer cutting its outlook for the year after first quarter sales dropped more than expected. Abby has more. Hey, Abby.
Hey, John. Well, I would categorize this one as worse than expected because the expectations going into this quarter were not great. Analysts, investor strategists talking about the idea that slowing consumer demand could weigh. That did, in fact, happen. Sales missed in a big way. They missed by about down, a miss by about 3%, down by about 4%. There were earnings of $3.82. That was a drop of 7%. The last time we've seen a decline in the numbers, the financials for Home Depot, goes back to February of 2020, right as the pandemic was starting. So they're talking about lumber and weather, but when we break down what was doing well and not well, millwork, building materials, hardware, and plumbing, that was strong. On the other hand, discretionary items, big ticket discretionary items, such as grills and patios, not really great. Now, relative to the outlook, that's also a big piece of it, maybe the bigger piece of it, that they have brought down the full year outlook. Sales comps were expected to be flat for the year. The CFO talking about after 43% growth over the last couple of years, of course it would be slowing, but now they're looking at sales comps for the year of down 2 to 5%. So again, worse than feared. This stock, John, down more than 10% on the year, down 24% last year. That equates a decline of 30% from the top. The question is, when will they see some sort of bottom? I think that folks might have wanted to see that out of the quarter. We simply did not get that.
The stock is trying to recover. It's down about 2.7%. Abby, thank you. Let's turn to financials. Capital One moving higher after 13 F filings revealed that Warren Buffett's Berkshire Hathaway added the stock to its portfolio in the first quarter. This coming ahead of the Senate hearing on the collapse of SVB and Signature Bank at 10 a.m. Eastern Time. Sonali Basak has more. Hey, Sonali.
Hey, John, if you take a look at it, it is a really remarkable tale of two cities. When you look at the financial system, you have Capital One just soaring pre-market, now down over 1 year, over 17% on the year. If you look at it, it's only really down 4% on the year. Why is that so remarkable? You have Capital One in the first quarter of this year, and Berkshire buying it anyways, by the way, John, in the first quarter of the year saying loan loss provisions have quadrupled. And with that said, the CEO has previously said they expect labor markets to significantly worsen over the course of the year. With that said, maybe Buffett is saying the worst is over and the market following them in. Remember, this is a management story as well. You have Richard Fairbank over at Capital One, really running the company since the 90s here. And if you look over at the likes of Silicon Valley Bank, we are talking about management once again and in a different way. We already have prepared remarks to kind of tease ahead to what we're going to see later today over at SVB and Signature as they testify in front of lawmakers in the Senate. And by the way, tomorrow gets even more interesting when you see First Republic's former executives testifying in front of the House as well. But interestingly, you have an SVB executive currently blaming the Fed, saying that for so long they said inflation is transitory and then hiking interest rates as fast as they had done. Remember, we know the Fed has blamed management of both Signature and Silicon Valley Bank as well. Let's see how much lawmakers do the same. And one thing we expect to see them do is address executive pay and stock sales of these firms as we look to how we turn the page from some significant bank failures in the United States and how banks should maybe be managed differently in the future.
With great difficulty. Sonali, thank you. The blame game down on Capitol Hill. What's new? That stock is up by more than 5%. I want to turn to tech, to Tesla, gearing up for its annual shareholder meeting later this afternoon after George Soros cut his holdings in EV makers, including Musk's company. Joining us now is Ed Ludlow. Morning, Ed.
Yeah, good morning, Jonathan. We got that from the 13F on May 12th as it relates to George Soros, a $16 million stake that he'd come into in the second quarter of 2022. But remember, at that time, Soros was looking quite broadly at tech. That stake now gone. I would also note on the Bloomberg this morning that JP Morgan, John Hancock, other names have cut their exposure to Tesla in the most recent quarter. There's actually a lot going on ahead of the AGM. I think we're up by about 0.2% or so, treading water. Bloomberg reporting overnight, according to sources, that in Shanghai, Tesla is getting near to trial production of an updated and revamped version of the Model 3. Slightly longer wheelbase, sleeker interior design, but that process of developing that product moving forward in Shanghai, according to sources. And then we had the AGM. We will get votes on board composition. Most interestingly, whether J.B. Strawball, a co-founder of Tesla, and of course the CEO of Redwood Materials, should be added to the board. Most investors looking at a shareholder proposal for Tesla to issue a key person risk report, a report which basically looks at individuals with the company and their core importance to Tesla, of course, with Elon Musk recently announcing that Linda Yaccarino will become the new Twitter CEO. There's been some thinking that Elon may now be more focused on Tesla, having been spending a lot of time at Twitter since April of last year.
Ed, thank you, mate. Appreciate it. That stock is positive by 0.1%. Mohammed, I wanted to come to you. Just looking at the equity market about 5 or 6 minutes into the session, we are negative by 0.2% on the S&P and the Nasdaq by 0.1. Can we go back to 2011? You're at PIMCO. You're going through this debt ceiling drama. What were the lessons from that for this right now? Lots of similarities for you?
Yes, except that this time around, the front end of the Treasury curve is behaving differently from back then. But I think the view then is the market view now for most market segments, not all, most, which is you should look through this, is going to be resolved because ultimately the consequences of a debt default are that both parties get blamed. So at the end of the day, you will get a solution. The question is, what are the compromises that need to be made? It's interesting that the principals are meeting today. Normally, you don't put the principals in the room unless the staff got to some sort of agreement.
And yet we're told that the staff haven't got to an agreement and have barely made progress, depending on who you listen to in Washington.
Yeah, depending on who you listen to in Washington. That's the issue, right?
Going forward from here, Mohammed, is it the European-type playbook that you need to get close to crisis before you provide a solution? Is it that down in Washington?
It is that for the debt ceiling, yes.
Do you see it spilling out from the at-risk maturities at the moment to somewhere else in the market, or does it remain contained there? Is there broader market risk here for you?
So I think the broader market risk is low, but that is what the market thinks as a whole. So if it turns out that we're wrong, there's going to be a lot of damage.
Plenty of reason right now, apparently, for some optimism and to be gloomy too. Bank of America's latest fund manager survey picking up on both the gloom and some of the optimism as well. Global growth expectations coming in at the worst levels of the year, pushing investors out of commodities and into tech stocks, reflecting the pessimism. The most crowded trade right now, long big tech, short banks. But the majority of investors still hoping for a soft landing rather than a hard one. The vast majority expecting a debt ceiling resolution before the X date. And survey participants, wait for this, forecasting just a 1% drop in global EPS in the next 12 months. I'm pleased to say that joining Mohammed and I to discuss this is Tony Dwyer of Canaccord Genuity. Tony, wonderful to catch up with you, sir. I picked out a quote from your note this morning. Everything is fine. You can tell us what FINE actually stands for in just a moment. You caught up with clients recently, and just based on those conversations, this is what you concluded. They are hesitant to get optimistic given the macro backdrop and increasing likelihood of recession, yet nervous to become overly negative given the damage that has already been done underneath the surface of the S&P 500. Tony, where on earth does that leave us?
Fine is where it leaves us, which is frustrated, insecure, neurotic, and emotional. And I don't see any reason that that's going to change. And going back to the whole debt ceiling debate, let's say it gets resolved in the next 15 minutes. Market's going to bounce. Right now, there's probably some investors that are not going into money market funds because the only thing they own is really short-term government paper. So there may be, if you do have more money flood into money market funds because of the debt ceiling debate resolution, you're going to have it come out of the deposit base, which is all in. It's going to increase the lack of availability of money and tighten lending standards.
What are you advocating for at the moment then, Tony?
John, I am annoyingly boring and consistent, which means we're light and tight. We're holding a bit more cash than would normally be the case, and we're slightly defensive. Again, with the Russell 2000 back to literally the pandemic low relative to the S&P 500, now's not the time to say, okay, things are really at risk. That said, you could get one more whoosh lower because there's 3 stages of a decline that's economic based. You get the good news is bad news, means Fed's going to tighten. We got that last year. You get the bad news is good news. Okay, they're going to take the foot off the throat of the market. That's been recent. And then you get bad news is bad news when you really actually have to price in a recession. And I think that's the final move when everybody's kind of panicking that I want to go on attack mode. So I don't want to get too negative, but I do want to own a little bit more cash and have a little bit more defensive posture.
Tony, a lot of people have picked up on valuation issues between the Russell and Apple. The fact that Apple is now worth more than all of the Russell. What would make you go long Russell, short Apple?
Well, Mohammed, I can't talk to Apple, but let's talk about the NASDAQ or the S&P 500 market cap indices. I don't think that's a bad, I've said it publicly, I don't think that's a bad idea right now. You're at a level that has already generated such a significant underperformance of the Russell 2000. And earlier, John, you talked about the Bank of America survey, right? And it said the biggest long is big cap tech, the biggest short is banks. That's the same trade, right? You're long, if you're long the S&P because it's index based, and you're short the banks, you're probably short the Russell. So that's really the derivative of that. And I'd like to point out, going into yesterday's close, guys, 99.47% of the market gain for the year-to-date gain in the S&P 500 was the top 8 stocks. It's a market cap index. Typically, the biggest stocks do have the biggest impact, but that's outside.
Well, Tony, just to clear something up, when you say you stand ready to buy into weakness, what does weakness actually look like there? Where are you looking for that weakness to buy into?
And there's the rub. So this could have come across as, really bearish, but it's below the October low. So here, let me throw some where it would be unique to have October be the low. When you look at it, we wrote a note that everything is fine. In that note, it has the New York Stock Exchange advanced decline volume line has made a new low. That's not happened before. Typically, that's surges. So if October was the low, this one's going to be historically unique on that. The S&P 500 has never made the low prior to a peak in the 2-year. So if October is the low, it would be historically unique because we made a peak in the 2-year on March 8th of 2023. And in addition, you've never made the low before you've had a recession, and you've never not had a recession with all the macro indicators that we talk about all the time.
Makes a lot of sense. Tony, thank you, sir. Tony Dwyer, great note this morning. Enjoyed the read. Simultaneously anchoring Bloomberg Surveillance and reading that note at the same time. Mohammed, how perfect is this? You go through the Bank of America Fund Manager Survey, and I think it sums things up pretty well. Global growth expectations, worst levels of the year, reflected in some of the pessimism out there that you hear. Investors going into tech stocks, out of the commodity story, the pessimism, the crowded trades right now, short banks, long tech, all of that. And then you get this idea of a soft landing, rate cuts from the Federal Reserve, get a resolution to the debt ceiling, survey participants only forecasting a 1% drop in global EPS. Does that all sound a little bit too perfect for you?
The hopeful part of it sounds a little bit too optimistic for me, but that is completely consistent with the behavioral side of investing. It's completely consistent.
What's going to change that? Data and time?
I think data, time, or an accident. And I hope it's not the accident part, but I hope it is data and time.
I think we all hope it's not the latter. About 13 minutes into the session on the S&P 500, we're just about negative by 0.1%. Coming up on the latest data, China data, disappointing.
Momentum for the growth is still not broad-based. It's still not solid yet. So the question is here, which policy stimulus is most important?
That conversation up next.
Between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it, and this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Momentum for the growth is still not broad-based, it's still not solid yet. So the question is here, which policy stimulus is most important? I think that industry policy probably will play a more important role than fiscal stimulus, particularly on the consumption stimulus. Monetary policy can play a supplementary role, but I think that the rate cut is not the most urgent policy response at this moment.
Whatever happened to the boom in China? Signs emerging already that the recovery is losing momentum. Official data showing industrial output and retail sales growing at a much slower pace than expected in April. The calls for stimulus already picking up. Michelle Lam of SocGen saying this. Today's data opens the door for further cuts in the reserve requirement rate and interest rates possibly in June. Damien Sassa joins us now for more. Morning, Damien. Your thoughts on that data overnight?
Yeah, no, I mean, the recovery is, it's lacking some substance here, Jonathan. I mean, for me, it's really about, retail sales, obviously. The decline there, month over month, sequentially, is pretty significant, and what we're seeing here is sort of a transition. It's going to be services-led, at least whatever recovery we do see in China. You're seeing demand for durables go down, and you're seeing youth unemployment rise to a record high. So that can't be good on a sort of structural medium to long-term basis.
Are we really at that point, Damien, where we're talking about stimulus, rate cuts, fiscal easing?
I mean, when are we now talking about stimulus in China, Jonathan? Of course we are. I think now we're looking for something on the order of a 10 bip cut in the one-year MLF. I think May 21st next week is going to be the next meeting there. We could see it then, certainly. But I think, look, investment in China is lackluster, has to do with the housing market. There's no signs of a recovery on that front. So look, the verdict is still out, but definitely the recovery in China is lacking in substance.
Damien, some people might be saying what happened to the boom, the big reopening trade that we're all talking about at the end of the year coming into 2023. Is there a sign of a boom somewhere in the services sector reflecting that reopening enthusiasm?
Yes, jet fuel demand, airlines. So you are seeing international flights come back online. You are seeing that kind of pick up. I think JP Morgan projects that jet fuel demand out of China is going to be responsible for 25% of all growth this year in energy demand. So, we're seeing a little bit of that now. Domestic flights have certainly recovered. But yeah, no, we need to see international flights pick up, and there's been a lot of cancellations from the big carriers in China, Jonathan, so I'm watching that pretty closely.
Interesting. Damien, thank you, mate, for the update. Damien Sassa there. Mohammed, back with us. Mohammed, I wanted to share this quote with you from Mislav Matejka at JP Morgan. Sums it up quite nicely to start the week. Just this consensus is starting to break just a little bit around China, around Europe. Mislav Matejka said the following: the activity upswing seen around the turn of the year, helped by the falling gas prices in Europe and by China reopening, unlikely to transition into an acceleration in the second half. Where are you now, Mohammed, on both China and Europe?
So I would agree with that. And I would agree with that because I listened to one person on growth issues, and that's the Nobel Prize winner, Michael Spence. And he's made the point over and over again that neither China nor Europe have potent growth models anymore, that the growth models that they had are no longer able to leverage the global economy like they used to, and therefore they have to accelerate their structural reforms at home. So once you get the bounce out of the way, the bounce in Europe from the energy shock, the bounce in China from the zero COVID policy, sustaining high growth is going to be much more difficult than what most people expect. And that's what we're seeing starting to happen.
So what does that mean for monetary policy at the ECB, given they've taken rates towards 4% and through 3%?
They only have one objective: inflation.
So lower growth, And ultimately, hopefully, lower inflation. Is that the future of Europe?
That is the way Europe is heading.
Or do you end up in the worst-case situation where you get the lower growth and the sticky inflation?
Inflation in Europe is not as sticky as inflation in the US.
Why not?
Because the underlying economy wasn't as strong to begin with. So you didn't get the massive acceleration of inflationary pressures and the move in survey. You know, we haven't talked today, but the 5 to 10 year inflation expectation in the US have moved up substantially.
You mentioned on Friday. What do you think that tells us?
That tells us that inflation is not proving to be sticky, yes, but in addition, inflation expectations are starting to react. And remember, inflation expectation, they move very slowly up and they take a long time to come down. So we have to pay attention to that.
So this goes back to how we started the conversation this morning. Is the effort to get inflation back towards 2 time sensitive? Is there a window here that if you don't achieve ultimately your goal, you end up with something nastier further down the road and something you've got to live with?
That window was in 2021.
You think it's closed?
I think it is very narrow right now. Very narrow right now. That window was wide open in 2021. Unfortunately, we got stuck with the transitory mischaracterization, and even when that was amended, the Fed didn't move quickly enough. But that window was wide open in 2021 and in the beginning of 2022. Now it has closed to a very large extent. Now we need some good luck to open it again, but I don't like relying on good luck, honestly, when it comes to such an important policy.
Are we going to be talking about the S word at the end of this year?
We're already talking about the S word.
Is that your base case now?
It's not my base case. I think this economy is more resilient than everybody that has called for a recession. You've heard me say that over and over again. When even Bloomberg Economics came up with this 100% probability of a recession in the first half of this year, I said, no, there isn't. Absolutely not. This economy is more resilient than most people realize. However, it is not resilient to lots and lots of mistakes, nor is it resilient to financial accidents.
Let's talk about this market right now. 22 minutes into the session, we are down by 0.3%. Let's get you some sector price action. Here's Abby.
We are looking at a small decline for the S&P 500, John. Not a lot of drama beneath the lid, though. If we lift the lid, energy down 1.2%, materials down about 1%, staples down 0.7%. Interestingly, consumer discretionary outperforming, even though it's down, being weighed on by Home Depot. On the year, or over the last year, it's interesting to see the outperformance for consumer discretionary and against consumer staples. On the year, it's even more pronounced, John. Discretionary up about 14%, staples up just slightly. Interestingly, Home Depot is consumer discretionary, but it has to do with Tesla and Amazon, Booking, McDonald's, Starbucks, a lot of strength there.
Coming up, the market moving events you need to be watching. That's next in our trading diary.
That was beautiful. You've got to thank the reporter, though, Mohammed. You've got to say thank you to Abby.
Oh, thank you, Abby.
And then do the tease. Your trading diary up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Equities just a little bit softer here this Tuesday morning. Good morning to you. Here's the trading tower at the top of the hour. The Senate Banking Committee holding its hearing on SVB. Fed speak continues with Richmond Fed President Tom Barkin catching up with Mike McKee at 10:30 Eastern Time, followed by an interview with Chicago Fed President Austin Goolsbee at 2:30. Debt ceiling negotiations resume at 3 p.m. Look out for that this afternoon. We round out the week with another round of jobless claims on Thursday morning, and President Biden attended the G7 Leaders Summit in Japan, and Chairman Powell speaking on Friday. From New York, that does it for me. Thank you very much for choosing Bloomberg TV, and thank you to you, Mohammed. Great to catch up with you. Thank you, sir. Just about holding on to this job here in New York City. This is Bloomberg.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from, and where has it gone? Because right now, it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign.
The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital. due to heart failure, still he had to attend the 2-branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris, and he noticed that in the aftermath of the attack,